think competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever. But nevertheless, talk to me about what you think the competitive landscape is going to look like here.
We've seen a bit of departures in this market, and this market has three very strong joint ventures that compete head-to-head daily to win the hearts and minds of consumers and businesses in the United Kingdom. So I don't see a difference in the competition. I think we've all focused on Heathrow as the major hub in the United Kingdom, connecting, of course, the US, New York, Los Angeles, and other locations. So I see this as a continuation of competition. We've been waiting for the day that we can compete strongly in the marketplace after such a long period of time where it's only been one directional traffic from the US to the UK, and now it's open, of course, to UK nationals.
You mentioned Heathrow. What about Gatwick?
We made a very tough decision in March of last year to really focus our efforts at Heathrow.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
From New York City this morning, good morning. On TV and radio, this is Bloomberg Surveillance, just pouring through the outlooks for next year. And of all of the outlooks we've looked at so far, one of the most optimistic, constructive views came from JP Morgan's Marko Kolanovic over in the investment bank. Lisa, Marko talking up about a full global economic recovery. It's the kind of note that reminded me of the kind of notes I read 12 months ago going into 21. That seems to be the playbook for 22.
You've made this observation that Q1 of 2022 may look a lot like the Q1 of 2021, or at least that's how investors. Right. At least that's how investors are setting up. And how much of that really dovetails from the China call? Because I know JP Morgan has been bullish on China, and Goldman Sachs, et cetera. How much pain has already been baked in this bifurcated recovery?
So what's Marko looking for? 50-50 on the S&P 500 year-end next year. Right now, futures come in 0.2% on the S&P, down 10. On the Nasdaq 100, down 90, negative 0.5% going into the Fed. That's the equity market call, but as you know, it's about the relationship between stocks and bonds, and the team at JP Morgan in the investment bank looking for 10s to get to 225 year-end next year. 143 at the moment on 10s, and Lisa, this is what I'm thinking about right now. If you get to 225 on 10s, where are 2s? I spoke to Mike Schumacher of Wells Fargo about that. He's looking for a move towards 2%, but he's looking for 2s to get to 160, so the yield curve to come down to about 40 basis points. So let's get to the curve right now, switch on the board and get to the yield curve. 2s versus 10s. That was flatter yesterday, just a little bit flatter today. And Lisa, we're back to 78 on that 2s-10 spread.
And how much is this basically people pricing in an overly hawkish Fed based on what they're going to do? And that, I think, when I read all of the notes, I wonder, what are people's positions on the Federal Reserve versus what is going on in data that is expected to slow? To me, I'm looking at how this dovetails into the dollar. Right now, I've been looking at all of these bifurcated calls about the dollar, how much has been baked in, and how much has yet to go, especially with the European Union. And Ibrahim Rahbari of Citigroup has been covering this quite a bit, covering head of FX analysis at Citigroup. Ibrahim, can I get your sense of how many rate hikes have been baked into the dollar? How much of the dollar strengthening has already front-run anything that the Fed could really do?
Well, we think there is a little bit more to come. So if we think of the Fed in the context of the other central banks, we think it is literally the one across the G10 spectrum where we can still hike, where we can still price significantly more hikes. So right now we're pricing about 65, 70 basis points by the end of 2022. We think that could go up to at least 85 as we expect 3 hikes and then 3 or 4 in the following years thereafter. So there's, I would say, over the next 2 years, probably another 50 basis points or so to go. And translating that into currencies, we think that there's usually about a 3% or so appreciation into the first Fed rate hike, which we expect in June. So that's broadly our reference point at this point, and that applies to euro-dollar as well.
So how much is that really the driving force behind the dollar versus some of the lockdowns that we're seeing, some of the restrictions, as you see the pandemic worsen in certain pockets and get better in others?
So I would make 2 points. One is we really are thinking of interest rate differentials as driving effects only if they're underpinned by growth differentials. And as you said, there are a number of reasons why the US is outpacing growth in the rest of the world presently. And some of them are good reasons out of the US, and some of them are challenges elsewhere, including rising energy prices in Europe once again. But there's also another reason, which is that in the present context, where you have a very mixed outlook, the dollar appeals, one, because of maybe US outperformance, but two, because there are challenges next year with central banks tightening. There are remaining challenges in China, even though we agree that maybe we will reach a bottom later on this year. So the two sides of the so-called dollar smile are appealing at this stage to investors, which is a different way of saying the dollar can also be a useful hedge against some of the risks next year.
Ibrahim, I just want to build on the rate differentials. It's kind of FX 101. It's what you first learn when you look at foreign exchange markets. I want to understand from your perspective, in the moment we're in right now, what matters more, nominal rates or real rates at the moment as you compare them around the world?
Yes, it's an age-old question, which I will slightly deflect, because as an economist, I would like to say it's the real rate differentials. But right now, when we look at euro-dollar, for instance, it's most closely linked to nominal 5-year spreads between the two. And there's a variety of reasons for it. We tend to say investors eat nominal, not real yields. It also may be related to the fact that, however we deflate nominal yields to arrive at those real yields, those markets tend to be relatively illiquid. So there isn't really a black and white answer, which is why we tend to look at both. But again, for the time being, it's nominals that tend to have the closest relationship.
Ibrahim, did you just suggest that our measure of real yields is maybe slightly distorted?
So I think that these are noisy measures, and unfortunately, there's no way around them. And I think they're better in the US than they are in many other economies. So, we're grateful for what we have, but they are definitely imperfect.
Yeah, data not always perfect, it would seem, but equally what's data I'm looking at here in Europe are gas prices once again hitting new record highs, whether they be traded in Europe, whether they be traded in the UK. You made a small reference to it there, Ibrahim, of the impact that gas prices are having on European central banking policy. Talk us through that.
Well, I think that for us, there are two impacts here that are relevant. One is European gas prices are high, and Europe, alongside Japan, is among the largest energy importers. So we think that's very relevant, the terms of trade impact, if you like, for currencies. For the central banks, it's actually a bit more of an open question. So, of course, Central Bank 101 is you kind of want to look through some of the, if you like, supply-driven increase in inflation that's showing up here. But the ECB has formed to react to energy price increases. Historically, it's been scarred to some degree by them. So when we look at the upcoming ECB decision, we do think that they will focus on the end of the disinflationary period to retire the asset purchase program. And I think energy prices are playing into it. But I don't think that they are the dominant driver here. They're just contributing to the end of the disinflationary cocktail, I would say.
The dominant theme of your recent research is that dollar smile, is that heads I win, tails you lose. The dollar comes up in either scenario. But you do go through some other risks to perhaps the viewpoint of that, some of them being a China rebound, some of them being a European recovery, and a dovish turn in the Fed. Just price in those risks. How are you hedging those?
Yeah, so we do think that there is definitely a scenario next year that could see the dollar sell off. And we actually came into this year thinking the dollar would be quite weak in the context of maybe even a multi-year bear market if the global economy holds up. But as you said, it is really about the Chinese slowdown bottoming and the combination of factors suggesting that once we get to June and maybe slightly beyond, markets have priced in the prospect of Fed tightening. So it's the combination of those two and maybe even the passing of the French election that could set off a bit more optimism about prospects in Europe in particular. And I think that should be seen maybe in terms of broader dollar dynamics. Right now, we would ascribe less than a third probability to it, but the probability is growing throughout next year. So it may end up being a bit of a tale of two halves in 2022 for the dollar.
Tale of two halves in terms of what you see in the front end and the back end. What about the two halves between the developed market and the developing world, given what we've seen in terms of rate hikes from the likes of Brazil? I don't want to even mention Turkey and what's going on there. That's its own issue. Are you starting to see any opportunities in the developing world, which is actually one of the most controversial calls in all of the outlooks I've been reading?
So it's similar in a way. So we think cautious now, but the prospect of arriving at a point where you find value in emerging markets. Right now, China is still slowing and the Fed is tightening. Interest rates are at least uncertain. They haven't definitively peaked. So that's not the point where we would get involved in emerging markets. But fast forward a couple of months, China may be bottoming more definitively, stimulus arriving, and US rates more definitively peaking, maybe even inflation peaking in a number of emerging markets. That could be the time to get involved. So we and our colleagues on the emerging market side, we're looking at that closely. We don't think it's quite the time yet.
Ibrahim, always good to hear from you, sir. Great to catch up. Ibrahim Raghbari there of Citi on its FX market and the central bank decision still to come. I think back to that interview we had on this programme with Vice Chair Rich Clarida in the middle of the year. And Lisa, we asked him a really simple question. As he pushed this transitory argument, how would you know if you're wrong? What's the tell on the calendar? When would you know? And he said at the turn of the year we'd have a decent idea if we were wrong. And here we are. And they've worked out they were wrong and they've got a shift. So where are we on the calendar from here? And it seems to me the baseline is inflation starts to fade going into the middle of the year. That seems to be where we are on the calendar. So from Q1 out to Q2. And this is what Morgan Stanley's picking up as well. And I think that's what divides the people who think we're going to get a hike soon, May, the likes of Barclays, maybe sooner, are threatening a move, say, in March, and those who think the Fed will wait much, much later through the year. It's how you think inflation is going to transition from Q1 into Q2.
What I'm watching most closely with respect to that trajectory is housing. A lot of people are saying that the lag effects are such that you're going to see a big pop in the CPI component of rents, of housing costs, really ongoing throughout the year, and it should be quite substantial. And I do wonder how that is offset by some of the more, dare I say, transitory elements, especially if supply chain disruptions don't get solved in the way that people were expecting, or at least on the timeline.
I hear you. I know exactly where you're going with all of this, Caroline. I think a lot of people are saying the same thing. We've got downside risk to inflation if supply chain issues heal, but you've still got this upside risk that comes from rents. So it's really hard to call still going into 22.
Yeah, rents, many feeling that that's the imperfect part of the data being measured in CPI at the moment. But I think also, how much does the dollar end up curtailing some of that inflationary pressure? We've got a great note coming out of Carl Riccadonna over at Bloomberg Intelligence today saying, look, maybe the dollar could do a lot of heavy lifting for the Federal Reserve. If that dollar does push higher, that can help ease an awful lot of the inflationary pressures going into 2022. Same sort of views being reflected by some of our guests coming up later in the hour. So that's going to be an interesting one as to how much that helps suppress elements into 2022.
Elisa, 96.14 on the dollar index.
Do we understand inflation? I know this is a really dumb question, but
how long do you want this conversation to go?
Well, I mean, you know, not to be philosophical on a Tuesday, but, you know, the more that I see these notes, the more you can kind of argue whatever you want, because people don't really understand the balance sheet's effect on inflation, low rates effect on inflation, people spending on inflation. I mean, you just go down the list and people disagree on the basis of what's the drivers here. So it's really hard to get a call.
That sounded so deep.
It is. These are the things I think about at night.
Sincerely, do you know what I want back? I want the Bramo column back. Can we get a monthly? Can we just get? I miss it. I used to read it religiously.
Oh, that's very sweet.
Can we get a monthly?
We'll see. I'll see.
Just so I'll read all 5 pages on what is inflation.
You can look forward to that.
Yields up a basis point on 10s to 143. Let's start lobbying Lisa to bring back the column. Futures down 13. We're negative a third of 1%. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. In the northeastern US, officials are trying every tactic to control a surge of coronavirus cases that has emergency rooms overflowing and infection rates soaring. New York is requiring masks in all indoor places across the state. Massachusetts is sending home free test kits to its poorest areas. Hospital admissions for COVID climbed 14% in the week ending December the 9th. Senator Joe Manchin spoke with President Biden, but still won't commit to voting for his economic agenda by the end of the year. The West Virginia Democrat says he's engaged with the president on the plan. Manchin's vote is critical for its passage. He says he has growing concerns about rising U.S. debt and inflation. The committee investigating the January 6th insurrection at the U.S. Capitol has voted to recommend that former White House Chief of Staff Mark Meadows be held in criminal contempt of Congress. Meadows has turned over material to the panel but will not testify under subpoena. His lawyers say he is invoking executive privilege. And Nike is diving deeper into the metaverse. The athletic wear giant has agreed to buy RTFKT, a company that creates digital products like sneakers and uses blockchain technology to ensure that they're authentic. No terms were disclosed. Last month, Nike debuted its Nike Land World by partnering with Roblox, the platform lets users outfit their characters in digital Nike items. Global News 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
From the worker perspective, a recent headline, you got Kellogg's Cereal Union says the latest agreement that they had was rejected. Deere had to finally make a union contract. How concerned are you about the longshoreman contract and union negotiations right now?
Well, we're some time away from that. The contract expires on the 30th of June next year, and both sides have told me that they'll sit down to the table and begin negotiating in May. These are always important discussions, and usually when the spotlight is on our industry. But there'll be some issues around wages. The industry is making a lot of money. The longshore folks would like to see that. Now, I don't speak for either side, but training and development of the workforce will also be key as robotics and automation are front and center. The workers cannot be left behind.
Yeah, but to that point, I mean, do you feel like the balance, though, has shifted? I mean, for so long, workers had a lot less negotiating power. Do you feel like the pendulum's shifting?
The International Longshore and Warehouse Union, which does work across 29 West Coast ports, is very strong and a democratic organization.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
safe workplace, which people want, you really can't, open up to Omicron. So I think that companies are looking at the data just like public health officials are looking at the data, and it wouldn't surprise me if they start requiring a third shot.
That seems to be the direction of travel. Joshua Sharfstein there, the Johns Hopkins Bloomberg School of Public Health Vice Dean from New York City this morning. Good morning. Alongside Caroline Hyde and Lisa Abramowitz, I'm Jonathan Ferro with futures down 12 on the S&P. We're negative 0.25%. A bit of breaking news, Lisa, on Pfizer.
Yeah, Pfizer releasing two separate studies of the COVID-19 pill. They talked about how they do seem to reduce hospitalizations. They prevent 89% of hospitalizations in unvaccinated individuals. However, they do not reduce symptoms in healthier individuals. Talking about this is the main key. How much do we start to pay attention to hospitalizations and not infections? When do we cross that threshold into treating this like the common cold rather than something that must be stopped at all costs?
Let's start the conversation right there with Dr. Amish Adalja, the senior scholar at Johns Hopkins Center for Health Security. Doctor, always good to catch up with you, sir. To Lisa's question, how much closer are we to that ultimate objective, treating this like the common cold?
Every time we get a new tool to use to treat people, to keep them out of the hospital, we get closer to that goal. And I think that the antiviral from Pfizer is one of those tools because it has a tremendous ability to prevent people from becoming hospitalized. And that is what this is all about. That's what flattening the curve was about, preserving hospital capacity. So I do think we're getting there. Obviously, the vaccine is the best way to get there, and we still have about 40% of the population that's not vaccinated, including 60 million people eligible to be vaccinated. That's the biggest thing, but I think the antiviral does bring us a lot closer to that.
We are looking also at the Omicron variant and anecdotal data out of South Africa showing that perhaps it is less virulent. How much are we looking at that being a breaking point to the upside and getting us out of the pandemic? Have you gotten enough data to get a sense of that yet?
The fact that all we're hearing about are mostly milder cases, not completely mild, there are people being hospitalized, but less ICU use, less oxygen use, I think that's reassuring because we haven't heard anything different. We know that in the US, I think only one of our cases had been hospitalized. It's a little bit difficult, though, to completely extrapolate that to the rest of the world or even to this country because South Africa is a country that's a little bit younger, has different comorbid conditions. We want more data on unvaccinated people, especially high risk. But it does seem that for the unvaccinated, it still might be just the same as Delta, and we may be trading Delta for Omicron. But if it's more transmissible, but even just a little bit less virulent, it may end up being a wash overall for what we're dealing with. So it all depends on how this all plays out in the U.S.
We've been talking about how the two-course dose of either the Pfizer, BioNTech, or the Moderna vaccine does seem to have some preventative aspect against Omicron in terms of how ill you get, but not necessarily infection. It seems a lot less efficacious. People are saying that the booster is really important. I know you said you did not get a booster. Have you changed your mind based on some of the incoming data?
No, I haven't, because I'm 46 years old. I don't have any comorbid conditions, and I think that a booster will just inevitably just kick a breakthrough infection down the road with these first-generation vaccines. If you're somebody that's above the age of 65, have a high-risk condition, got the J&J vaccine, those people absolutely should be getting boosted today. But for healthy people, I think that's not going to change the trajectory of Omicron. It's not going to prevent Omicron from hitting our hospitals. What's going to prevent Omicron from causing a problem are first and second doses. And as you said, the Pfizer data shows that people are protected against what matters, severe disease, with a two-dose regimen if you're healthy. And I think that's what we need to be emphasizing, because if we continue to boost to prevent mild illness, I don't think that this ever really ends. And I think we really have to focus on severe disease. And maybe there'll be a second-generation vaccine that gives us different types of protection than our first-generation vaccines. And that will change the equation. But right now, I haven't seen anything that changes what I would say for healthy people. I might be in the minority, but there are a few of us that really are focused on hospitalizations and not so much preventing mild disease with these vaccines.
Okay, so Dr. Adalja, as I sit here in the United Kingdom and I see the absolute focus on booster shots, perhaps over and above getting the unvaccinated with the first realm of injections, how does that pan out in the UK? Because we were talking to Robert Reid a little bit earlier, who's one of the advisors to the government, and he's saying that the reason is to stop the transmissibility, to prevent people getting in and being able to spread if you help with the boosters. But does that not work from your mind's eye?
it's not going to be the most significant way to stop spread. The best way to stop spread is going to still be to get the unvaccinated vaccinated. Because if you look, it's not a surprise that this variant arose, likely in Southern Africa, where vaccination rates are very low. So if everybody in the UK that was eligible for a booster got boosted today, you would still have an Omicron problem. And the same is true in the United States. If everybody that's eligible to get boosted, we still would have hospitals busting at the seams in many rural counties. This is really about reaching the unvaccinated, and many policymakers have given up, so they continue to boost the people that are already vaccinated, but that's of much less value than getting first and second doses into people. And I think that they've recalibrated to focus on cases because they've given up on the unvaccinated, and I think we can't give up on the unvaccinated because I have to work in the hospital, and that's all I deal with. I don't deal with boosted people coming into the hospital or fully vaccinated people coming into the hospital. I deal with people who lack first and second doses. And if we want to end this pandemic, we have to get first and second doses into people in the US, the UK, and all around the world.
Doctor, what have been the most effective ways of doing that, bar making it illegal not to? From your perspective, what are the ways you convince your patients who are still thinking and on the fence about it to a certain degree?
The only thing you can do is talk to them one-on-one and try and figure out what bit of misinformation they swallowed. Offer them alternatives. Look at their concerns. Maybe they don't want an mRNA vaccine, so you can direct them towards a J&J vaccine, or vice versa. Get them to get at least one dose and then maybe wait a little bit longer to get the second dose. There's ways to work with people, but you have to actually sit down and do it. It's not me on television that gets people vaccinated. It's actually when I'm sitting in a room saying, what are your concerns? And let's go through the ingredient list. Let's go through this. That's how it really works on a detailing basis. Just like if somebody's making a purchase, that you have to go through all of their questions, and then I think you do nudge them appropriately. And we didn't do that. We did a lot of pontificating and talking on high, and I don't think that really moved that group of people who were vaccine hesitant.
Doctor, appreciate your time, sir, and always your perspective on what's happening inside the room. Dr. Amish Adalja there of Johns Hopkins, just on the situation right now in hospitals in America, Lisa, and what we're grappling with. I think we're still struggling to understand the degree, the scale of the hospitalizations from the Omicron variant, trying to get a fuller picture of that in the UK, some competing numbers. I think some people misspoke about what was actually happening in the UK a couple of times over the last 24 hours. A fuller picture starting to come through slowly.
And we're still fighting the Delta variant. And that, I think, is what Amish Adalja is talking about when he talks about emergency rooms busting at the seams, ICUs busting at the seams. And that is the variant that we do know is virulent and concerning. I was struck by a story about hospitals that are dropping their mandate for vaccines for their workers because they are running out of workers and they need to keep operating at a time when they are absolutely overly full.
It's really, really tough right now. Caroline, what is the update over in the UK? They seem to have a lead on maybe the rest of Europe at the moment.
Yeah, unfortunately so, in terms of the numbers, 200,000 cases per day, the fact that about 20% in the United Kingdom is currently now of the Omicron variant, and even higher. We were, what was it, breaking the news yesterday that by today it would be the most prevalent in terms of variants here in London. It does feel as though people are starting to get really nervous about what happens ahead of Christmas. I'm personally nervous. My sister's expecting a baby. What then, John?
Of course, they test more in the UK. They do better sequencing, so the UK is kind of where everyone's looking at the moment. Lisa Brabbits, Caroline Hyde and Jonathan Ferro, your equity market down 10 on the S&P, negative 0.2%. This is Bloomberg.
antibody responses produced by this vaccination is able to potently neutralize the virus and a number of variants of concern. A lot of the vaccines being developed currently require super cold storage. One of the great advantages of our patch is that we're able to remove the cold chain. We've been able to stabilize the vaccine on the patch for at least a month at room temperature and a week at 40 degrees. So this makes logistically vaccine rollout a much simpler proposition, removing the cold chain from transport.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging. We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I don't think it's the great resignation. I think it's the great reshuffle, and people are reflecting on what do they want and how do they want to work and how do they want to live their lives.
We're seeing more and more of the Fed members becoming a bit more worried about inflation.
The economy's been overheating for most of this year.
The Fed has turned really hawkish. They're getting really aggressive.
Every time we get close to a Fed tightening cycle, markets tend to get really aggressive.
The flattening yield curve is suggesting that it won't take much to break something.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
One more day. What is it, 20, how many hours, Lisa? 30-something,
You're the
40?
one that's counting it down.
I don't know.
You
From
have
New
it
York
off.
City, for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Together this morning with Caroline Hyde. TK back with us tomorrow. Your equity market down 11 on the S&P, negative 0.2%. Elisa just pulling back a little further from all-time highs.
Okay, you keep saying that the year is going to be over, and people are really tepid in terms of trading ahead of that Fed meeting, which really is the key event tomorrow. Do you actually think that we're going to get anything dramatically market moving tomorrow?
I have no idea. Maybe we will, maybe we won't. Isn't it interesting regardless?
It is interesting regardless. I actually wonder what could possibly be market moving other than the balance sheet, because we already have the idea of an accelerated taper in place. And what benefit do they have to really knock the market off course at this point? A lot of people watching the dots, figuring out how far out they sort of increase their inflation expectations. But I really think the balance sheet, from what I've heard, is the only thing that could really knock markets.
I hear you. That's exactly what Citi has made as well. In their research, they've made that point. Caroline, the idea that we're expecting a quicker taper, expecting the dots to shift, the hawkish surprise would be a balance sheet call, balance sheet reduction as part of the sequencing for the year ahead.
Yeah, never underestimate, though, perhaps some central bankers to move away from a hawkish pivot, as they did a U-turn here in the United Kingdom. Omicron's going to be the key line of questioning for the Federal Reserve as to how focused and how resilient their call of being that much more hawkish will be if we do indeed start to see more shutdowns or indeed impact to the economy.
I'm certainly not the only one who wants this year done with. Lisa, just looking at these headlines that have just come out from our reporting, the likes of JP Morgan, the likes of Goldman, some reporting about how big those bonus pools might be for this year.
They're big. They're really big. JP Morgan has said weighing in their booster, they're looking to boost potentially their bonus pool for their bankers to up to 40%. 40% gain, given how hard those bankers have been working on the mergers and acquisitions that have been running at a record pace. Goldman Sachs weighing whether to increase its bonus pool for those investment bankers by 50%. I'm sure people want the year to be over so they can actually go and spend some of that money doing something.
So they can take those phone calls and find out how big that number actually is. That's the news that just comes out. JP Morgan said to weigh, boosting the banker bonus pool up to 40%. Goldman having a look at boosting their pool by 50%. Some great reporting from the team here at Bloomberg. From New York then, here's the price action for you. Equities down 10 on the S&P. We're negative 0.2%. Pulling back just a little bit, adding to yesterday's losses. Yesterday yields were lower. Today they're just a little bit higher by a couple of basis points to 143.77. We'll talk about the yield curve in just a moment. And in foreign exchange, Lisa, euro positive back through 113. Euro dollar positive a third of 1% to 113.19.
It's all constructive in the United States, certainly. It's constructive in the U.S., perhaps less so over in Europe. I wonder how long companies can keep absorbing the costs of higher prices, how much they can just keep passing them along to consumers who are running out of some of the savings from the pandemic era. At 8:30 a.m., we get that U.S. November PPI data highlighting how much the end products that factories are putting out, that manufacturers are putting out, have gotten more expensive. And frankly, it has absolutely surged to the highest levels in decades and expected to continue. Again, margins have been a record level. They have been able to pass this along. What is the sticking point as people start to get more concerned about inflation on the consumer side? At 12 p.m., we hear from Homeland Security Secretary Alejandro Mayorkas. He's planning to speak at the Bloomberg Technology Summit. How much does he reiterate what Tony Blinken, Secretary of State, was saying yesterday over in Southeast Asia about China and the threat of cybersecurity coming from that nation? Is there this ongoing hardline thread that we hear from the White House and from the administration with respect to the China policy? And then at 9 p.m., talking about China, they're planning to release retail sales, industrial production, and property investment data, looking at the slowdown that a lot of people are expecting to see in China. And frankly, bad news is good news over in China, because what you're seeing is people pricing in and easing in policy in the People's Bank of China. And that's why you're seeing yields tick downward, particularly on the front end of the Chinese yield curve, John.
Lisa, just to pick up on that, is it an easing of fiscal policy or an easing of monetary policy that we're building up for here?
People are looking at both. You're looking at another rate cut, which we have gotten basically expectations for pretty broadly, but also this idea that some of the curbs and leverage, particularly in the property sector, will get lightened just a touch in order to counteract some of the contagion that people have started to see in a number of different property developers.
Lisa, on the day ahead, the next couple of days into the Fed tomorrow. Lisa, thank you. Looking ahead to the year ahead as well, we have a new big bull on Wall Street. It is Oppenheimer's John Stolfus. We'll catch up with him a little bit later this morning. 53.30 is his view for year-end on the S&P next year. We're going to talk to the biggest bull on the street a little bit later. We have to talk to the biggest bear on the street as well. 4,400 the price target over at Morgan Stanley. And we can catch up with Dan Scully, the head of market research and strategy at Morgan Stanley Wealth Management. Different side of the business, Dan, but you work very closely with Mark Wilson, who straddles both sides of the business. So let's talk about the call for a lower equity market. What I hear from you guys going through the research is not a less constructive view per se on earnings, but it's about the multiple, Dan. What's going to bring that multiple down? Dan, what is it about the multiple that you're focused on at the moment?
That's exactly right, Jonathan. Good morning and good to see you. Happy holidays to you and the team. So look, as we've been saying for the last several months, we think there's more room to go on multiple contraction. And that has historically been the case, Jonathan, as we've worked through mid-cycle transitions. We think it is basically the same scenario this time around, okay? Even though we've had extraordinary circumstances in this particular cycle, given COVID, given lockdowns and reopenings, et cetera, we think things are somewhat tracking to a normal historical context, which has seen the multiple come down anywhere between 10 to 15% as mid-cycle transitions culminate in the past. So we do think there's more room to go on valuation.
And as to this point, you said we recently halved our exposure to the equity-like asset classes. Can you give us a sense of where you put the money as you took down your exposure?
Sure. Yeah, absolutely, Lisa. So we put some money into alternatives. We've also put some money into a shorter duration credit as well, some high quality credit. And look, valuations and spreads aren't exceedingly undemanding there either, but we do think that could offer some ballast in portfolios as we go into a little bit more volatile period. You know, as you well know, we've been through this anomalous smooth sail upwards over the last, call it 16 to 18 months, where we really haven't had your typical 10% correction in the S&P, and we don't think that's going to continue through the winter months.
Okay, so brace for a 10, 15% correction. What gets us there? What's the snap element that suddenly drives us lower? Is there, I mean, we get PPI data a little bit later today. I know inflation has been a key area of risk you're looking at.
Correct, Caroline. And so we do see a bit of a gradual unwind here, and positioning has already started to move that way, particularly when you look at some of the faster moving institutional funds out there. Positioning has started to lighten up more recently, but we think it's simply the market acknowledging that the Fed is about to announce this week, the big event, of course, about to announce a much faster taper schedule that will conclude in March. That's going to obviously remove the maximum accommodative stance that we've had. And even though folks have known about this, they've been preparing for it, I think there's a difference in terms of the actual effect in markets over the next several months.
Dan, where in this equity market do you like? I know there's going to be much more emphasis from you and the team at individual names, individual sectors. Where do you like right now?
Jonathan, in this type of backdrop, we favor defensive, high-quality names, okay? So from a sector's perspective, think healthcare, which is trading extremely cheap after underperforming this year, but has all the benefits of innovation and growth, but it's not priced like many of the growth sectors. Think areas like consumer staples. I know pricing power was just mentioned earlier. You have to be selective. Not every global consumer franchise has pricing, so you have to do the bottom-up work. And then, Jonathan, on the other end of the barbell, we're actually not shying away from growth names either, except here's the nuance. We want to focus very much so on growth at a reasonable price. We're looking at actually names we've added to our team's portfolios recently, names like MasterCard, names like T-Mobile. These are actually structural growers that are significantly off their 52-week highs. And if we do get into an environment where rates finally start to back up into 2022, they won't be as acutely sensitive to higher rates as some of the really high multiple growth stocks that worked this year.
Dan, you and others have been talking about a 10 to 15% correction, which is overdue for a while. A lot of people have been saying things have been flying a little too high for too long to be really justified in any fundamental level. And yet every dip has been buyable, and that dip doesn't matter how small it is a buyable dip. Has that made you rethink your thesis based on the fact that you're seeing cash piles increase, at least according to the fund manager survey coming out of Bank of America, and a sense of caution among some of your peers?
It's a fair point, Lisa. One thing I would say is that particular dynamic in and of itself has not made us back away from the call or change the call. We do acknowledge that the individual investor in particular, given the amount of, in particular, the millennial wealth coming in and the new investors coming in to access this market via technology and apps and so forth, that has been a particularly strong force and frankly higher than we would have presumed coming into this year. But nonetheless, that hasn't made us change the call. What would help us change the call or make us adjust the call would be, number one, we're wrong on rates, right? So instead of getting to 2% or 2.1%, which is Matt Hornback's call, we hang out around these levels. An equity risk premium for the S&P aren't as challenged. And number two, we've been calling for a bit of a pushback or a slowdown in the consumer. The consumer has eaten through a tremendous amount of the savings that you just referenced. And so they've also been pulling forward tremendous demand for particularly durable goods, given we've been all at home for so long. We don't see some of those trends continuing as well, and that's part of our more near-term caution. That being said, if we're wrong about rates, if we're wrong about the consumer, those would be some of the aspects that would change our call.
Dan, can I just say thank you? You've been a good friend of this show, a wonderful partner over the last year. Send our best to Mike, to Ellen, to Matt, to Lisa Shallett. Just fantastic, Dan, as always, and good to hear from you, sir.
My pleasure.
Dan Skelly, thank you. Enjoy the holidays and send our best to the team. Lisa, they've had a tough time calling the index, but they've had some really interesting calls beneath the surface. I think of small caps earlier on this year, and just a sector rotation have been calling for as well.
Yeah, and the idea right now that they're talking about selling some of the most loved areas that a lot of people wrote off earlier in the year, namely big tech or some of the most high-flying stocks. I'm thinking about Apple when we get to $3 trillion.
Just around a corner.
Maybe.
Just around a corner. Maybe. Perhaps. Today. Could be. Possibly. Coming up on the program, from the less constructive view to the biggest bull on Wall Street, it's John Stolfus of Oppenheimer joining us at 8:15 Eastern Time, about an hour from now. Don't miss it. From New York, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. 2 studies out today show mixed results about Pfizer's experimental COVID pill. According to data, the pill was highly effective at keeping patients out of the hospital, but it didn't do as good of a job at raising milder symptoms, often associated with breakthrough infections. The results suggest the Pfizer pill will likely be used for COVID patients at risk of developing severe disease. And the UK will use its soccer stadiums and race courses as it opens up hundreds more vaccination sites in the coming days, according to the government. The new Omicron variant now accounts for 20% of the confirmed cases in England. The estimated number of daily infections has climbed to 200,000. And U.S. Secretary of State Antony Blinken lashed out at China whilst trying to rally allies in Asia. Speaking in Jakarta, Blinken criticized what he called Beijing's aggressive actions in the region, and he emphasized U.S. efforts to deliver high-quality infrastructure and vaccines to Asia whilst working closer on security issues. Goldman Sachs and JP Morgan are opening their wallets to try to keep bankers happy. That will put pressure on their rivals to do the same. Bloomberg's learned that Goldman may boost its bonus pool by 50%. JP Morgan may increase its pool by 40%. The 2 banks dominated this year's deal-making frenzy. They may have to overpay to keep the people that they want the most. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Rishka Gupta. This is Bloomberg.
To cut emissions, climate-proofing transportation is at the top of the list. 20% of global CO2 emissions come from transportation. 75% of transport emissions come from road travel. And 45% of road travel emissions come from passenger vehicles. 29.4% of road travel emissions come from freight. Of the world's transportation emissions, 11.6% comes from aviation, 10.6% comes from shipping, and 1% comes from train travel.
For breaking news, the world turns to Bloomberg.
Big news, the United Arab Emirates will switch its weekend to Saturday and Sunday. The UAE is breaking rank with the rest of the Gulf region.
Now we are aligned with the world economies.
The working week will be 4.5 days, with Friday, a holy day in Islam, being a half day.
Positioning itself as being an international hub.
I haven't once seen this as a gap or a concern by international investors.
The interesting thing will be to see how the private sector does respond.
The power of Bloomberg.
How does an extra $1 trillion in spending not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the President's agenda, what I like to call the big deal. But Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of healthcare, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
They will narrow the bid and ask between Senator Manchin and Senator Schumer and the rest of the Democrats. They're not going to make their Christmas deadline, that this is going to bleed into January. But I'm still very optimistic that they're able to get a $1.3 to $1.5 trillion package done in early January.
1.3 to 1.5, a very different size package there. Isaac Boltanski there, BTIG Policy Research Director from New York City this morning. Good morning. Caroline Hyde out of London. With me in New York, as always, Lisa Abramowitz. Tom Keene back with us tomorrow. Your equity market down 6 on the S&P 500, negative a little more than 1/10%. Yields higher by a couple of basis points to 143.77. No drama here. The Nasdaq 100 coming in a fair bit in 0.4%, down 71 points on a session so far. I did say a little bit later this morning we'll catch up with John Stolfus of Oppenheimer, 53.30 on the S&P, Lisa, year-end next year. And here's the quote: "We do not expect the Fed to slam on the brakes, but rather we look for the central bank to pump the brakes as lightly as it can."
Don't you think that he looked over at BMO and saw their
went
call
up 30
and just said, you know, it's worth 30.
You can ask him that at 8:15 Eastern time.
I can't wait.
How did he get to 53.30 specifically?
Yeah.
We can ask him that a little bit
Just
later.
saying.
Right now, we need to talk with Mario Parker. He leads our political coverage down in Washington, D.C. Mario, naturally, I've got a Wall Street bias. My questions are along the lines of what people will want to hear down in D.C. about policy, the fiscal effort. I imagine you are absolutely drowning in news about January 6th. Is that right, Mario? Is that where the focus is right now in Washington?
Yes, that's correct, Jonathan. Absolutely. Among all of the other things that's going on in Washington, the January 6th Commission, some of the bombshells that came out last night are just remarkable and has our attention here in Washington, D.C. First and foremost, just the repeated text messages from Fox News personalities, allies of the president as well, urging Mark Meadows, the former chief of staff, to have the president say something to stop the insurrection at the Capitol on January 6th.
We're trying to push this forward for a financial audience. Is there any kind of ramification from this that affects sitting lawmakers, that affects policy in some sort of way that currently is not being factored in?
Yeah, it's not entirely clear right now, Lisa, as to what policy implications these have. Obviously, it puts heat on some of these lawmakers with text messages revealed particularly as we head toward the 2022 midterms. The last thing many of these congressional lawmakers who may have been in contact with the president want is to be in the spotlight for reasons like this.
Well, the reason why I ask is because we're still trying and talking about the Build Back Better plan, that it looks highly unlikely at this point will get passed before Christmas, as many people had wanted. And I think of a polarized Washington, D.C., with President Trump, the former President Trump, being one of the most polarizing figures out there. How much is that really representative of the Republican-Democratic divide right now? Or are we still talking about internecine issues for the Democrats and a core group of Republicans and Democrats that are in the center trying to work together?
Yeah, right now it's internecine disagreements between Democrats. But as you allude to, which is exactly on point, Democrats have to go it along. Right? So in order to pass this legislation, it has to be the Senate, the Congress is the Democrats have a very thin majority. So anything that has to be passed along party line votes, right? So essentially, Washington is extremely divided. This puts the spotlight on a conversation like we saw yesterday between Joe Manchin and President Biden, as opposed to perhaps President Biden moving across the aisle, which is just inconceivable right now, given the current climate in Washington.
Mario, always good to speak to you. Talk to us about, therefore, what brings Joe Manchin on board, if at all, this year or in early 2022? What gets a deal done? Is it just it has to shrink if he's so focused on the Fed, he's so focused on inflation?
Yeah, well, I think last week when the inflation number hit, just speaking about what we're looking at in Washington, I think Washington collectively turned and looked at Joe Manchin, expecting what type of response we would get from him, whether or not we could read the tea leaves as to whether or not he would support the BBB. Right now, the good news for the Biden administration is that he hasn't ruled anything out, right? So that's a good thing. He hasn't ruled out calling on Schumer to not vote on it this year. He hasn't publicly advocated for it to be kicked down the road necessarily, but at the same time, he's a man that doesn't appear to be in a hurry either. He has questions, and he's really asking for those questions to be answered along the lines of inflation and then just, federal priorities.
From $3.5 trillion to $2 trillion to potentially $1.7 trillion, as Joe Manchin is currently asking for. Meanwhile, as you just referenced him, Chuck Schumer does seem to think we're going to get a deal done or wants it done by Christmas. I mean, just put the probabilities on that for us, Mario.
Well, we got less than 2 weeks, so it looks more grim as the time passes. Again, Schumer's publicly advocating for a vote to happen by Christmas. Every day that passes makes it less likely. But again, the hope and the silver lining for them is that Manchin hasn't come out and said ultimately that he doesn't want this to pass or that he doesn't want it to pass before Christmas. So there's still hope.
Mario, you're wonderful, and I enjoy hearing from you. Mario Parker there, down in D.C. Mario, thank you, buddy. Just wanted to turn from a call to a call from Evercore. Another upgrade for Apple on the price target. Lisa, they go from 200 rather, from 180. They call it one of their top picks for 2022. Room for sustained upside. This stock's been climbing, close to 180. They go from 180 to 200.
Bank of America also going overweight Apple, saying it's a buy. The answer to me really lies in why for a lot of these particular analysts. Is it just that the consumer is strong and that Apple is a dominant player in the market, or is this an issue of virtual reality, augmented reality, these sort of new products that Apple is putting out there? What I find interesting is some of the bullish calls that have been the most bullish have been done without even factoring that in. And then you put that on top of it, and a lot of people are seeing a lot of potential gains for Apple.
Caroline, the analyst Amit Daryanani saying the following: the monetization of the install base across services and wearables, new product launches, and margin expansion. That's his call for Apple next year.
And he's not alone if he's going to 200. There's 5 other analysts out there that currently say that the price target should be 200 or above, the most bullish being JP Morgan overweight 210. This is a company that has 2 sells on it, 39 buys. And even amid some of its own supply chain issues, that means that new watch that you wanted to get, it's been very slow coming.
2 sales, just 2 sales on this company. 39 buys, holds are at 8, 2 sales. And one of the sales, Lisa, Pierre Farragut over at New Street, 90 is the price target.
90. Wow, that's a very, very aggressive.
Lowest on the street.
Yeah, you know, when you say bigger margins, that means more expensive, right? What's the price tolerance, given some of the entrants that are at a lower price point, and given that we're already getting used to $1,000 for something that we put in our pocket? It just is amazing to see how high some of these prices can go and how big these margins can get.
Absolutely. Sounds like you're struggling ahead of Christmas, Lisa.
It's not personal.
Well, you've already
but,
revealed that it's personal because you told us earlier in the week that the kids are complaining about the supply chain because of Apple.
The flow charts come out.
What do they want? The headphones? What are they asking for?
No, one of them is getting a phone for the first time, which I'm very concerned about, and the other one is waiting for his AirPods.
When you were 10 years old, did you get gifts that were that expensive? Because
Absolutely
I didn't.
not.
All I wanted was a football to play outside with.
Yeah, no, I hear you.
From New York, this is Bloomberg.
what do we know and what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concern for many reasons. But also, we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be to protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new variant. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that, as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
From New York City for our audience worldwide, live on TV and radio, this is Bloomberg Surveillance, and here's the price action right now. We're down 5 on the S&P, we're negative 0.1%. On the NASDAQ, we're down about 0.4%, just inching back from all-time highs, going into that Fed decision tomorrow. Jonathan Goldberg of Credit Suisse has done some wonderful work on the last 4 rate hiking cycles. So Lisa, the mid-90s, the end of the 90s, 99, 2004, 2015, the last 4 rate hiking cycles, and the performance in the 12 months leading up to that first hike, and a performance in the 3 years after. The performance in the 12 months leading up to it, positive 9.5% on the S&P 500. The 3 years after, positive about 26%. Jonathan Goldberg making the point, guess what, that this equity market can keep on performing, so long as the yield curve doesn't do this. Switch at the board and we can talk about the bond market. 2s and 10s, the distance between the two, switch at the board again and we'll get to the distance between the two. Your yield curve looks like this. 78 basis points. And Jonathan Goldberg's point, Lisa, is that so long as this stops flattening and does not invert, then it's good to go, a green light for equity bulls right now. And Jonathan Goldberg is constructive on the S&P next year for that reason.
The economic story here is that the Fed would be hiking rates into strength, not into weakness. And as long as the bond market reflects that they're moving appropriately due to the strength of the economy, stocks should rally. And that, I think, is the question. Are we going to see a strengthening in the momentum of the U.S. economy next year, or will we see a deceleration as some of these base effects roll off?
I'm smiling because we've worked together for so long. I know what you're thinking. You're thinking, does sub 150 represent capture a good story in the outlook? I was thinking about this in a commercial break, and we talked about it briefly. When we first broke 140 on 10s back in the summer of 2016, I think it was towards the end of June, middle of June, maybe the start, we had a very, very different backdrop. We were thinking about a China-induced global recession. We had nominal growth nowhere near where we are now, and CPI certainly nowhere near the 6.8% we're at right now too. And yet here we are with a 10-year at a very similar level. The backdrop for this one is radically different, Lisa.
People saying this is a distortion, people saying it's QE, people saying it's global savings, it's going into the bond market. It is a mystery, but if you listen to the bond market, it is not necessarily sending the all clear that perhaps you would like to see if you are going to get super bullish.
Calling the bond market, I think, is one of the hardest things to do right now. Kathy Jones of Charles Schwab's going to weigh in on it, so wait for her. Not for us.
No.
In the bond market right now, the distance between 2s and 10s is about 78 basis points. That's the cross-asset price action. Let's get you some single names, some movers this morning, and say good morning to Romain. Morning, Romain.
Hey, good morning, John. You take a look at some of the individual movers. Pfizer, once again, at the top of the board. Shares only down fractionally, about 0.4%. Got the latest data on that COVID pill it's been working on. A mixed bag here. Basically, if you have serious symptoms, you're hospitalized, the COVID pill actually had some pretty good efficacy. If you have just mild symptoms, maybe not so much here. Still has a long long way to go before it gets approved here, but depending on how you look at it, could be encouraging, could be not. Now, what's not encouraging here is Tesla down once again, now down more than 20% since Musk tweeted out that request as to whether or not he should start selling shares. Of course, we know that that share sale plan was already in effect. Now about 13 million shares sold, including about another 900,000 that was disclosed in a filing last night. If you include exercisable options, you're talking about 17 million shares worth now have been sold here over the past few weeks here. And of course, we're still on Apple watch here, whether it gets to that 3 trillion or not. And you got a lot of analysts now raising their price targets. Bank of America going to a street high, matching 210. Evercore ISI actually putting it on their basically their best ideas list for next year. John, I overheard you talking. I know you're just kind of a simple man who just needs a ball and a stick to entertain themselves. But kids today, John, they really need those iPhones, and that's going to potentially drive earnings.
What's the stick about, Romain? What's the stick about?
Just a ball.
I don't know. Isn't that what goes on in the streets of London? Stickball?
Wasn't that a wheel?
I don't know. I don't know what's going on.
If you watched Scrooge recently, because wasn't that what the kids were doing in the movie?
You could go back to the 1920s.
They were rolling a wheel with a stick.
I don't know. Those are all the British stereotypes I know. Where's Caroline? Is she still on this program? Anyway, flip up the board here. Let's get just a quick look at some of the other things here.
I love a British stereotype. You know me.
Yeah, we know. She puts up with this with me all the time. 3M here, Alcoa. You don't really care. Ralph Lauren down about 4%. Interesting downgrade though. Keep an eye on Ralph Lauren. Double downgrade today over at Goldman Sachs. The note was actually pretty bearish overall on some of the brand recognition and retail strategy right now with that company, John.
Romain, thank you.
Yeah.
That's an odd British stereotype. Just kids running around with sticks.
And a ball.
What have you been watching, Romain Bostic at a close a little bit later?
He just wants you to play baseball.
Baseball?
A stick and a ball.
With a stick?
Yeah.
Oh, a small ball. Don't we call that cricket, Caroline Had? That's a different game.
It's a good game because you get to eat tea during it.
And drink
what
beer
other sport can you
through
eat
the
tea
day.
During?
What other sport can you drink beer for like 10 hours? Not many.
I don't know. You can ask a soccer player sometimes, I'm sure.
That's very true. Kathy Jones joins us now, Chief Fixed Income Strategist at Charles Schwab. Kathy, we've got to talk about this bond market. We went through it with Lisa. 2016, when we were at these levels, we were talking about a global recession. What are we doing now?
Yeah, it's really a conundrum, I think, for the Fed, because as they try to signal that they're tightening policy, all we get is a flatter yield curve and lower long-term rates. And I think that tells you that the market's view is that inflation isn't going to last a long time and that growth will decelerate next year. And that we have enough demand at the long end of the curve to prevent yields from rising very much. So it places a lot of pressure on the Fed. How high can they go in terms of rate hikes and not invert the yield curve? And that's going to be probably the biggest problem they face over the next 12 months.
Kathy, what would you say to the argument that the bond market, I don't want to say is wrong, but is distorted by quantitative easing, by the savings glut, by what's going on overseas?
Yeah, I don't think it's distorted, but those are certainly factual. That's factual evidence that can contribute to low bond yields. And clearly, if there's one surprise that the Fed could pull off, it would be quantitative tightening, right? If they really wanted to see long-term rates move up, they could start selling bonds and reducing the size of the balance sheet. I don't think that's going to happen anytime soon, but that would certainly be one way to do it. But I think the collective wisdom of the market here is that, yeah, we have a lot of factors holding down long-term rates. The global savings glut isn't going to go away tomorrow. Aging populations aren't going to disappear tomorrow. And that continues to make demand at the long end of the curve for, 20, 30-year paper very, very strong. And that's the reality in the bond market. I think that's reflected in this flattening curve.
And that's why you call a terminal rate of 1.75%, Kathy. Talk to us, therefore, about looking out further along the risk spectrum. How much are we going to see an outperformance of potentially high yield if you are going to see such tamed long end in government?
Yeah, high yield and investment grade have been doing great. Again, credit has good, strong fundamentals here. The problem is, of course, the yield, right? So you're not getting much spread over treasuries to take that risk. But it's hard to see in this environment that credit won't continue to outperform treasuries in 2022. It's really just a question of how much risk you want to take in terms of moving into the lower credits. for the event that we get some sort of an accident in the market, or certainly if we were to get an inverted yield curve, that would be a negative signal. So it's all good except the yield in the credit world, but I do think it will outperform in 2022.
Kathy, just finally, something Lisa and I talked about in the last hour. What would a hawkish surprise look like tomorrow at the Federal Reserve? Can you just give us a little bit more detail on that, on how they could surprise hawkishly at the FOMC?
Yeah, I think, they could raise that terminal rate. I'm not sure that the result would be a sell-off at the long end. It might actually be a rally at the long end if they did that, but they could move up that terminal rate. Or again, quantitative tightening. They could start announcing roll-off sooner rather than later. And I think that would be a surprise to the market.
Kathy, a ton of people writing in. Do you know what they miss? Do you know what they miss the most?
She knows.
She knows. The piano. They miss the piano. Can Schwab not let the piano into the office?
That might be a heavy lift.
Open a window. We'll sort the crane out for next time. Kathy Jones. And Kathy, thank you for everything this year. Just absolutely wonderful on this show and others. Just a wonderful partner as we work through some really, really complex issues, particularly, Lisa, in this bond market.
So if the yield curve is distorted by some of these factors that aren't going anywhere, then how predictive is it for economic reading? How much does it really give us a sense of what the outlook is in a concrete way when you have negative real yields into the future? And that, I think, is what everyone's grappling with. I mean, Jonathan Golub basically talking about the flattening yield curve as some sort of indicator, but how much does it lose its power that way based on some of these other factors?
Well, clearly when you have a price insensitive buyer in any kind of market, the economic signal that you get from that is incredibly distorted. I think we're all on board with that. Regardless of that, do you think the Federal Reserve would be comfortable hiking interest rates into a flattening yield curve?
Which is the reason why the point that we were just talking about here of a possible roll-off in the Fed balance sheet would be more of a possibility if they want to allow the long end to rise a little bit to avoid that type of signaling. And that would be really quite a big shock to a lot of people who aren't expecting that yet.
Not an exact science, of course, but Caroline, I was looking at the last rate hiking cycle that started at the back end of 2015, and the curve, the difference between 2s and 10s was north of 120, right now sub 80 basis points. I just wonder if you think that would make a difference.
Yeah, I mean, the interest is the reporting and some of the work being done by analysts out there as to that you've never seen, not for decades, this sort of a flat, weak yield curve overall, and then purchasing within that, seeing that sort of rate hike from the US. Unlikely. What's interesting, though, is we talk about how shocking it is to have a real yield that's negative in the US. Here you have nominal yields that are negative in Europe, and still the ECB, many wondering, in fact, if they have a hawkish surprise come Thursday, will they indeed start to say, look, we're not happy with this sort of inflation rate, lower than in the US, but still above 5%?
Are you implying that something happens after tomorrow? That there is another day?
Potentially.
Still to go.
You might miss something.
The ECB and the Bank of England. Lisa, are we done with the Bank of England?
I'm not,
We just
no.
kick that into next year?
I mean, maybe we're done with having any faith in them to be reliable in any way, as sort of Marcus Ashworth was discussing yesterday. But no, it's going to be fascinating. How do they deal with the fact that they're facing an Omicron variant, they're facing potential restrictions, and they've kind of promised something that seems unlikely they're going to deliver?
I'm really excited for your coverage of it.
I'm sure
Thursday
you are.
Morning,
You'll call
sterling
in.
right now.
We'll call you.
Negative 0.25%, positive 0.25%.
Where will you be?
On sterling.
On the
I'll
beach?
Be somewhere where I can take your call. If they hike, I'll take your call.
Okay.
Okay?
Really?
I promise.
Is
I'll
that a
take your call.
promise?
It's a promise. If they hike interest rates, I will take your phone.
Everybody heard that. Okay.
And I'll admit that the year's over now on a Thursday instead of Wednesday.
The stakes are high.
Equities down 0.2 on the Nasdaq, down 77, negative 0.5% from New York. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. In the northeastern U.S., officials are trying every tactic to control a surge of coronavirus cases that has emergency rooms overflowing and infection rates soaring. New York is requiring masks in all indoor places across the state. Massachusetts is sending home free test kits to its poorest areas. Hospital admissions for COVID climbed 14% in the week ending December the 9th. In Kentucky, authorities now say at least 74 people died in tornadoes last week. 14 were killed in 4 other states. Efforts have now turned to repairing the power grid, sheltering those whose homes were destroyed, and delivering drinking water and other supplies. The committee investigating the January 6th insurrection at the U.S. Capitol has voted to recommend that former White House Chief of Staff Mark Meadows be held in criminal contempt of Congress. Meadows has turned over material to the panel but will not testify under subpoena. His lawyer says he is invoking executive privilege. The International Energy Agency says that relief for the tight oil market is on the way. It says there's now a surplus in the market, and the agency forecasts an even bigger oversupply early next year because the Omicron variant is impeding international travel. And the IMF warns that the British economy is headed for a mild slowdown early next year. That's because of tighter restrictions aimed at limiting the spread of the Omicron variant. The IMF is forecasting 5% growth in 2022 after a 6.8% increase this year. And it says inflation will peak at 5.5% in the spring. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg. Front, when your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation, and we believe that the quarter three was the quarter that was most effective.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Happy holidays from all of us at Bloomberg.
happier to buy a dip if you have the ISM services at all-time highs and generally growth in the US is running incredibly strong. The more the kind of mix of real yields and growth is deteriorating, the more difficult it gets to buy a dip.
Looking ahead to a more complex 2022, Christian Muller-Glissman there of Goldman Sachs, the Portfolio Strategy and Asset Allocation Managing Director. Your equity market -9, down 0.2% on the S&P 500. On the Nasdaq 100, down 77. We're -0.5%. Your bond market yields are higher by a couple of basis points to 143.60 on 10s. And in the commodity market, basically unchanged at 71.26. Taking a look at crude this morning, I'm pleased to say, is Bloomberg's Kriti Gupta. Morning, Kriti.
Well, good morning, John. We are, of course, seeing $71 a barrel for WTI, 74 on Brent, but it's those oil time spreads that I really want to keep an eye on because it's really that real-time impact of the Omicron variant. So if we look at time spreads for Brent crude on a 1-month to 3-month spread, essentially shows you that the near-term premium for getting a barrel of oil is dropping. And a lot of that has to do with worsening demand. A lot of that, of course, tied to the Omicron variant. The spread at about 40 cents a barrel, or 40 cents, I should just say. If it goes negative, that starts to signal that the market is in contango. Essentially, it's oversupply. That near-term demand just isn't as strong. And the IEA actually coming out this morning, the International Energy Agency, saying, well, a new oversupply is actually being created and could get worse next year. So on the surface, John, it sounds like worsening demand, more supply. Well, oil prices should drop in theory, right? But then again, you have OPEC, the Saudi energy minister last night, saying he's in constant communication with his peers and actually warning traders not to short oil because OPEC Plus could react very quickly. So yes, this week is all about the Fed, the BOE, but John, we're going to have to keep an eye on the Central Bank of Oil, of course, OPEC, and their reaction to the Omicron variant's impact on oil.
Fair to say they've got some skin in the game, some big skin in the game. Kriti, thank you. A wonderful chart of the day. Just to start this conversation off now with Ellen Wald, Senior Fellow at the Atlantic Council. Ellen, the supply piece of this is something you're thinking about. Just how much of a production rebound can we get through next year? Where do you have your doubts?
Yeah, it's interesting because the IEA is seeing supply growth from the U.S., from Russia, from Canada, from Brazil, all converging next year to actually create a 1.7 million barrel per day surplus of oil as soon as the first quarter of next year. And while Russia has definitely been steadily, slowly, but surely increasing its production in line with the OPEC increases monthly and bringing back shut-in production, it's not altogether clear that they have invested in capacity to increase their production further. And then the U.S. is just a huge question mark here. We're definitely not going to see a return to the massive growth that we saw in prior to the pandemic, but the IEA thinks that the U.S. will hit record levels of production next year. So it's not really clear where this production is going to come from in the U.S. and how they're going to get there.
Ellen, for much of the pandemic, we've been talking about the demand side of the picture, the fact that people are traveling less, flying around less, and now increasingly we hear the conversation shifting to supply and how much supply can truly come online, how much can be available, and how quickly. Do you think that that's the correct dynamic to be looking at right now, or do you think still demand is the big driver as we look at the Omicron variant and the variables there?
I do think that demand is a very important component of the picture. It's interesting because both OPEC and the IEA are seeing less impact economically, globally, from the Omicron variant, though the IEA was pretty much honing in on the fact that it sees the variant impacting mostly jet fuel demand. Of course, jet fuel demand was the big question mark, and previously was seen to be really surging, especially in 2022. In fact, jet fuel demand was supposed to make up a lot of the increase in demand in the coming years. So if we do see jet fuel demand suppressed, that's not an insignificant issue, though it's perhaps not as great an issue as was previously feared, especially on the Black Friday oil drop that we saw in November.
Ellen, going back to the supply side, and of course yourself, a historian, a scholar in energy markets, but also the relationship of the West with the Middle East. And I'm thinking at the moment of talks with Iran that seem to be well, not going anywhere, deteriorating, particularly between Western leaders and Iran. What are the supply side there going into 2022? Because that was quite a hit on oil prices but a month ago.
Yeah, Iran is again a big question mark in terms of supply. When they came out with a budget for the following year, they definitely seemed pretty optimistic about their ability to export more oil. However, that doesn't necessarily seem to be reflected in the progress of the negotiations between the U.S. and Iran. In fact, we have seen some reports recently that the U.S. would actually is actually trying to crack down even harder on Iranian oil exports, the illegal ones, and to enforce sanctions even more harshly than they were before. So that could definitely hurt Iran's ability to export oil and oil products, particularly to Venezuela.
Ellen, good to hear from you on an important topic. Ellen Wald there on the crude market. We heard from JP Morgan in the last couple of weeks, doubting the spare capacity of OPEC and having a little look at the prospect of maybe breaking through 125 on Brent next year, 150 the year after that. I want to turn back to an important conversation about the Fed, though. Who remembers President Kosher Lakota of the Minneapolis Fed from, say, 2009 to 2015? Lisa, I remember a very, very dovish central bank president, incredibly dovish. Reading what he's got to say in Bloomberg Opinion, and you pinged this one over to me, that's a different man.
This is rhetoric that is on the verge of alarmist, especially with respect to how quickly the Fed should be moving. A pretty hawkish statement, just to give you a sense of flavor. If officials don't announce a much more aggressive path of interest rate increases that I expect they will, their passivity will risk a repeat of the great inflation of the 1970s. He was talking about how we are seeing a scenario as we did in 1965, where the increases seemed controllable in CPI and the consumer price indexes and the producer price indexes, but it spiraled out of control. And he said that that is the risk if the Fed isn't aggressive enough. And this comes from somebody who has talked extensively about his transformation from hawk to uber dove when he headed the Minneapolis Federal Reserve.
It goes back to the middle of the 1960s when the Fed didn't have much to worry about then, and then ultimately in the 70s they did. He writes, in principle, the impulse from the added spending should have been temporary, but it fostered an inflationary psychology in which prices and wages began to rise in anticipation of future price and wage increases. That's that virtuous cycle we've been talking about for much of the last year, and something Lisa Mohammed Al-Aaron has talked about repeatedly going into year end.
Which is the reason why one of the most important points that people look at in terms of data is the University of Michigan survey and inflation expectations over the longer term. How much do inflation expectations drive what actually transpires when you go to the store?
Really interesting column out on Bloomberg Opinion right now. The Fed faces a troubling 1965 parallel. Coming up, John Stolford says there's nothing to worry about. 8:15 Eastern Time, the biggest bull on the street, looking for 53.30 on the S&P. Right down -9, we're down by 0.2%. From New York City, on radio, on TV, this is Bloomberg Surveillance.
先から、灯油の単価が上がるよと連絡があったのが10月の初め頃。当初はこんなに上がると思ってなかったんですけど、初めに5円上がる。その先10円。で、その次に3円上がる。で、また今日ちょうど2円上がったので、ここを銭湯ついでから20円ほど上がってしまったんです。
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I don't think it's the great resignation. I think it's the great reshuffle, and people are reflecting on what do they want and how do they want to work and how do they want to live their lives.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
For breaking news, the world turns to Bloomberg.
Big news, the United Arab Emirates will switch its weekend to Saturday and Sunday. The UAE is breaking rank with the rest of the Gulf region.
Now we are aligned with the world economies.
The working week will be 4.5 days, with Friday, a holy day in Islam, being a half day.
Positioning itself as being an international hub.
I haven't once seen this as a gap or a concern by international investors.
The interesting thing will be to see how the private sector does respond.
The power of Bloomberg.
People are not well positioned for the environment that we're envisioning now.
Going into the first quarter, there's a lot of question marks.
There's a risk that all markets go down, both long-term treasuries, equities. There's really no place to run, nowhere to hide.
What people forget is negative real yields are a very, very positive thing for risk assets.
At least for another year, I think stocks are still the best game in town.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
The Hawks are out in force from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Together this morning with Caroline Hyde. TK back in a seat tomorrow. Your equity market declining, pulling back a little further from all-time highs, down 9 and -0.2%. Lisa, we've heard from Lacker, from Dudley, and now we hear from Coach Lakota, another former Fed official, ringing somewhat of an alarm.
What do you make of the fact that former Fed officials are increasingly vocal about their alarm, about inflation, about the sort of dovish tack that the Fed has taken up until now, basically encouraging them to go fast, not just with near-term rate hikes, but their longer-term projections, which I personally am going to be watching in their announcement tomorrow?
There's a difference between saying this isn't transitory and then really ringing the alarm about something much, much worse. In this piece, and you read it out moments ago, I'll read it again. If officials don't announce a much more aggressive path of interest rate increases than I expect they will, their passivity will risk a repeat of the great inflation of the 1970s. Is this parallel between the 60s and, say, the 70s and what's happening right now?
It highlights how new this environment is in the last 30 years. We have been fighting disinflation. We have not been fighting inflation. We have not seen inflation, and people have basically thrown out the curve, the Stanley Fischer curve of this real idea of unemployment, low unemployment rates leading to higher inflation. All of a sudden, people are saying, wait a second, we don't understand how long-lasting this could be, but it seems persistent, and we don't understand how it comes down.
Caroline, the former Minneapolis Fed president, reflecting on the middle of the 1960s, the early 70s, and the inflationary psychology of that period. Is there a parallel now between what we're seeing at the moment and back then?
Well, it depends as whether you're focused on inequality as well, as I thought the Federal Reserve was at the upcoming of 2021. The focus wasn't just price stability, it was ensuring you had an inclusive jobs market. Now, from what I remember, yes, unemployment is coming down, what about 4% or so? But for black unemployment, we're still at 6.7%. The issue, though, is inflation becomes a societal issue. If it's going to hit those with the least money, those with the lowest income, quite often that ends up being an inequality element too. So you have to take both into focus. But for me, it's so interesting how quickly we've moved on from that debate of inequality to focusing on inflation.
That was always the fear of a lot of people, Lisa. If you kept monetary policy too accommodative, it would overwhelm a sustainable and inclusive recovery. And arguably, that's what we're seeing play out right now.
We had the luxury of talking about that when we didn't have inflationary pressures. There's a great story in Bloomberg Business Week from Matt Bosler and Olivia Rockman exactly about this. Does the Fed have to move away from its inclusive kind of mandate for the employment market because inflation is just too pressing of a concern?
Let's whip through the price action right now. This Tuesday morning, one day still to go. Equity futures down 8 points on the S&P. I often have to look, Lisa. It's that time of the year. I often forget the guest names too.
I'm there with you.
I've got Mike Bow next, though. I know that. I know Mike well.
And
Your
Lisa.
equity market down 8, and I think Caroline's with us in London too. I'm keeping up. We're down 0.2% on the S&P. Yields up a couple of basis points to 143.60 on 10s, and in around about 12 minutes' time, we'll catch up with the biggest bull on Wall Street. John Stolfus of Oppenheimer, Mike Bow of JP Morgan joins us now. Mike, John's looking for 53.30 on the S&P year-end next year because he believes we're not going to get this quick tightening cycle. They're going to tap the brakes as gently as they can through next year. Mike, what's your view on that?
Well, to be honest with you, I think even if they put rates up 3 times next year, it's not going to have a major impact on the stock market. We look at the interest rate sensitivity of the US economy now, and it's much lower than it was in past cycles. So as interest rates go up, I think the impact that will have on the economy and the stock market is going to be lower than it was in the past.
Mike, why isn't the dovish stance of the ECB providing more of a boost to some of the outlooks for that region in terms of risk assets?
I mean, I think at the moment, obviously, Europe's being held back a little bit by everything that's going on with Omicron, as is the case globally, but particularly weighing on Northern Europe, where you've got pretty high hospitalizations and as a result of that, some of the lockdown measures in place. I think that, if we get through COVID, then Europe's pretty well set up, but we've got this kind of near-term headwind to deal with.
The reason why I ask is because over the past 10 years, it was don't fight the Fed, don't fight the ECB, where you saw an easing central bank just pour money into risk, where you saw a tightening one take a step back and reconsider. Now we have the opposite, where people are saying, let's go into the United States because the Fed's going to be hiking rates for the right reasons. Do you think that that's accurate? Is this the new paradigm that we're in?
I think ultimately what's so different this time around is the labor market healed so quickly. So you compare with the last cycle, it took many, many years for unemployment to get down to these kind of levels. Today it's healed incredibly quickly, and therefore we're in an environment with above target inflation and fundamentally that wage inflation that looks like it's going to be sustained, and therefore an environment where the Fed should be putting rates up. But as I say, I don't think it's problematic for the economy. I think the US economy could withstand north of 2% interest rates just fine at the moment. So, I think the Fed should be putting rates up, but I don't think that investors should worry about it too much.
It's interesting we got that labour data out of the UK earlier today, Mike. Yes, backward looking because, of course, we now focus on Omicron for the month of December. But we did see record high certainly record high payrolls out there at the moment. But also so many people falling out of the labour market. And how much is that, when you say, look, the labour market bounced back, how much is there a worry that, for example, from the UK, an awful lot of Europeans went back to Europe and people retired?
I think that is an issue that you're seeing in the UK that's exacerbating what already looks like a very tight labour market. The retirement issue is a global one, so we see the same picture in the US. These hopes that you're going to see a very substantial rebound in the participation rate. I think, a lot of those over 55s probably aren't going to come back because when you look at the net wealth gains that have taken place, they're extremely substantial. So I do think you've got tight labour markets both in the UK and the US. And hoping that a lot of those over 55s come back and that participation rises, it's not really that wise.
Wage pressure, both in the UK and the US. Issues, though, of Omicron, both in the UK and down the line in the US too, we think, Mike. Why was it right, or has it been right for the Bank of England to make such an dovish pivot, having lined us up so significantly to think we were going to get some sort of rate hike as soon as this month? But then the US at the moment, many a hawkish tone coming for still the Federal Reserve to stay on course.
I mean, I guess what I'd say is that, if Omicron proves to be a serious problem, and it's too early to say for sure, but if people who've been booster jabbed end up in hospital, and lots of them end up in hospital, then clearly interest rates are not going to be going up anytime soon. And I would say that's the case both in the UK and in the US. At the moment, I think the market's willing to sort of look through that and assume, well, the Fed will speed up the pace of their taper because it gives them some flexibility. But I think, the Fed rate hikes that people are expecting for next year, they are dependent on Omicron not being a problem. Likewise, I think here in the UK, it makes sense for them just to wait until February to see whether Omicron ends up being a big problem or not. If Omicron is a problem, then, rate rises are going to get delayed, for sure.
No hike on Thursday then, Mike. Is that a call?
I think it'd be wise for the BOE to wait, just because we don't know yet. I mean, there's some positive signs. If you look at hospitalisation data in the UK, they're not rising materially yet, but it may just be because there's a lag between infections and hospitalisations. I think we'll know sort of by early January how much of a problem Omicron is. I think that the UK is really the perfect real-life experiment for markets to be focusing on. We've got a very high proportion of over 50s who've been booster jabbed. So if you start to see people who've had their booster jab ending up in hospital in significant numbers, then we know that we've got a problem globally. If you don't, then we know that things are in a pretty good place, and then the kind of narrative around central bank hikes comes back on the table.
So, Mike, year over, yeah, after the Federal Reserve tomorrow?
Leading the witness.
Just done. We all go home? I think we do. I'll make a call for you, Mike. It's fine. Mike Bell of JP Morgan Asset Management. I'm really struggling to recruit people to this effort, Lisa.
Well, people don't want to write off the uncertainty of a Bank of England decision, and I personally am biased right now because I hope that they do hike simply so that we can get you on the phone and for you to say the year was not over on Wednesday.
You can't say those kind of things. You can't say that you hope a central bank does something.
I mean, tongue in cheek. I mean, come on, because then you promised you would call in from wherever you were. We could see a picture out your window.
You want a video call?
Yes, I want you to do a Zoom call. I think it'd be fabulous.
A video call.
No, I mean, honestly, what's interesting to me is that everyone's written off COVID. I mean, there are sort of peripheral concerns and just in case, but if you look at these surveys of investor confidence, no one actually cares about the COVID pandemic as a major risk going into 2022.
I think what Mike said there, though, about the UK being a fantastic case study, in many ways, Caroline, it really is, because the amount of testing that we do in the UK, the fantastic sequencing we have, we've got some really good data to work with.
And worrying data as it stands. You're getting 200,000 cases per day at the moment in the United Kingdom. The fact that it is so transmissible, the fact that you do have relatively high vaccination rates here in the United Kingdom, and already we're talking about whether or not Christmas will be as we envisage. Already we start to see the knock-on effect on the travel industry here in the United Kingdom and the economic damage that that might have. I ran home yesterday. The places were empty. People are not going out right now.
You're still running home. I remember that from 10 years ago, Caroline. Same place.
Got to get it in where you can, John.
It was amazing. Caroline Hyde, straight into the sweatpants, ready to go, into the running shoes every day in the afternoon in London.
Shall I tell you I now have a Peloton?
I would get the tube. Caroline would run.
You know that I do the same thing, right?
What would you? You run too?
I run home.
Yeah, you ran past Tom and I once. We tried to get you to come for breakfast. You wanted nothing to do with it.
I had to go pick up the kids.
Of course you did. Futures down 6 on the S&P, down 1/10%. Lisa never wants to hang out with us.
Come on.
That's the truth. That's the truth.
Invite me.
You get invited all the time. You always say no. From New York, this is Bloomberg.
With the First Word News, I'm Rishka Gupta. 2 studies out today showing mixed results about Pfizer's experimental COVID pill. According to data, the pill was highly effective at keeping patients out of the hospital, but it didn't do as good a job at erasing milder symptoms often associated with breakthrough infections. The results suggest the Pfizer pill will likely be used for COVID patients at risk of developing severe disease. And the UK will use soccer stadiums and race courses as it opens up 100 more vaccination sites in the coming days, according to the government. The new Omicron variant now accounts for 20% of confirmed cases in England. The estimated number of daily infections has climbed to 200,000. And Toyota is making it clear that it's serious about making electric vehicles. The world's biggest automaker plans to invest more than $35 billion to supercharge its EV push. It has a target of selling 3.5 million vehicles annually by the end of the decade. Toyota says it plans to roll out 30 electric models by 2030. Goldman Sachs and JP Morgan are opening their wallets to try to keep bankers happy. That will put pressure on their rivals to do the same thing. Bloomberg's learned that Goldman may boost its bonus pool by 50%. JP Morgan may increase its pool by 40%. The two banks dominated this year's deal-making frenzy, and they may have to overpay to keep the people that they want the most. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What do you think competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever. But nevertheless, talk to me about what you think the competitive landscape is going to look like here.
We've seen a bit of departures in this market, and this market has three very strong joint ventures that compete head-to-head daily to win the hearts and minds of consumers and businesses in the United Kingdom. So I don't see a difference in the competition. I think we've all focused on Heathrow as the major hub in the United Kingdom, connecting, of course, the U.S., New York, Los Angeles, and other locations. So I see this as a continuation of competition. We've been waiting for the day that we can compete strongly in the marketplace after such a long period of time where it's only been one directional traffic from the U.S. to the U.K., and now it's open, of course, to U.K. nationals.
You mentioned Heathrow. What about Gatwick?
We made a very tough decision in March of last year to really focus our efforts at Heathrow.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
How will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that
over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Sheet has really kind of distorted what happens with PE multiples recently. If you expect sort of a flattish balance sheet over the next year or so, what that should tell you is that we should have a flattish PE multiple. It's really when you get into quantitative tightening and you contract the balance sheet, that's what the recent history is telling us should cause the contraction in the multiple. So it's just very complicated right now.
I know we're not meant to have favorites, but Laurie Calvasine is one of my favorites. RBC Capital Markets US Equity Strategy Head there. From New York City this morning, good morning. Lisa Abramovitz, Caroline Hyde and Jonathan Ferro. We're down 8 on the S&P. We're negative 0.2%. Down 70 on the NASDAQ. We're down 0.4%. And in the bond market, yields are higher by a couple of basis points to 143.77. In about 12 minutes from now, we'll get PPI data in America. It's crystal ball time. It's your outlook for 2022 on the S&P 500. We'll do bottom 3, top 3. Bottom 3, most bearish, less constructive. Morgan Stanley at 4,400, B of A at 46, Barclays at 48. Top 3, Credit Suisse at 52. We've got Deutsche Bank at 52.50, and then you've got BMO at 5,300. And then rounding it out, just shaking up the whole table, going number 1, a new entry in the last 24 hours. John Stolfus goes to 53.30. He joins us now, the Chief Investment Strategist at Oppenheimer. John, let's start here. Where did the extra 30 points come from? And what did Brian Bowski do to you to upset you?
Well, Belsky and I are old pals from way back, even though we haven't talked with each other for about a year, just pre-pandemic. We ran into each other outside of the exchange. He was coming out, I was going into the exchange, but we haven't spoken. But when I looked at it, I just looked at the numbers. We were looking at the momentum that we've been seeing in these rallies, the broadening of interest in equities, and the propensity of the indexes to essentially self-correct in the course of rotations and rebalancing that can happen day to day, not waiting for week to week or month to month. So a healthy market, the economy coming back, we just...
Fed to slam on the brakes, but rather we look for the central bank to pump the brakes as lightly as it can. John, what separates you and others? Why do you see it as a central bank that's going to step on the brake, just pump them as lightly as they can?
Jonathan, I think it's the context that we bring to it. You know, this is, I'm 38 years on Wall Street, so I remember the Alan Greenspan era. Gosh, I even remember Volcker. And so, you know, this is the Bernanke legacy of Federal Reserve. It's highly sensitive when it addresses its mandate of full employment and a stable economy to achieve that. And so we think they're going to be very careful. But the irony, though, of all of this is the market is freaking out because the Fed is getting really considering, you know, tapering at a more aggressive pace. The market has been dying for the Fed to taper. It says if the Fed's behind the curve, give it a break and let it taper, and it'll get to actually probably tweak the benchmark rate, the Fed funds rate, probably later next year, 6 months to maybe 9 months out from where we are now.
You're touching on one of the biggest debates on Wall Street right now. Does a faster taper mean a sooner rate hike? And a lot of people seem to think that the answer is yes, and can they potentially separate those two a little bit more at tomorrow's press conference is a key question. My issue, though, given this call, is that you're looking for 12% earnings growth for the S&P 500, a real robust consumer throughout 2022, and yet a Fed that remains patient and has the confidence to do so despite this robust data. Can you explain, sort of dovetail those ideas?
Well, we think that right now, you know, we think people are overspending. We think the what do you call it, the stimmy checks, the amount people saved when they weren't commuting to work, what have you. People have more money on a relative basis, depending upon where they fall in the income strata, and they're spending it, you know, right now at a certain pace. But the effects of the gasoline pump prices going up, the effects of prices of meat, poultry, and pork, etc. All of this adds up. The consumer will bring it in a little bit, but the consumer is not going to stop spending. My big thing has always been don't don't bet against the American consumer, as well as don't think that technology is going to end and we're going back to the abacus or the slide rule.
Don't bet against the consumer. Don't bet against, in some ways, the supply chain that's been affecting the consumer as well, John. I'm interested in whether you see any risk to your overall focus from Omicron from any way, or indeed the way in which the consumer reacts to that.
I've got to say, the Omicron risk is significant. In some ways, it's just as to how it is. It is looked at from afar by people who are not epidemiologists. By the risk and the element that can cause over concern. I say let's leave it to science. So far, science has done an incredible job. If we look back to 2020, when people thought it was going to take 2 years, 4 years, or who knows when for a vaccine of efficacy, we've come a long way. Technology boosting that. And then I'm sorry, I missed the next part of the question. Oh, the consumer. Was that it? Yeah, the consumer has shown, the consumer has shown a great desire to shop, whether they do it online or bricks and mortar or a mix of both. The consumer wants to get back to the next new normal or get to the next new normal, because I don't think we're going back to what the normal was in the memory of this pandemic for quite a few years before people forget it.
So are you going to call for Apple to be a $4 trillion company by the end of 2022?
Well, the firm doesn't like me to comment on specific names because
that's basically the index.
But needless to say, related to technology, we think technology continues to be something that investors want to have exposure to. You have to break up what you're looking at. We like more established companies. We think the newer ones, it's terrific for risk and volatility. But if that's what you want, know that you're not going to get those steady earnings, steady cash flow, process of innovation, and within a culture, within a corporation that's established, and a certain relationship with shareholders that gives you less volatility, generally speaking.
John, you squeezed out the extra 30 points. You are the most bullish on the street going into next year. John, it's great to catch up, sir, as always. John Stolfus there of Oppenheimer. Thank you, John. Thank you, sir. Lisa, something you just said I think is so true. When you make up 7% of the index, it's hard to imagine we go on the S&P 500 out from 4,700 rather, to 5,330, and we don't get a nudge up to a $3 trillion market cap on Apple.
How much is Apple the market? How much are some of these big tech companies really drivers of all returns? And how bifurcated can the return picture be if you see an underperformance, if you do see higher yields? To me, I'm looking at this, and if the Apple goes to $4 trillion, then why not, 53.35?
53.35. Would that be your call, just to go an extra? No, that would not be your call.
Not
You'd be looking for 4,300 just to be on the downside. Brilliant lineup of guests today. So we've got John Stolfus, the most bullish on the street. That's behind us. In front of us is Mike Gapin of Barclays. Mike Gapin is looking for a rate hike in May. That's the earliest call that we've got on the street right now, and a risk they go even earlier, perhaps in March. I'm looking forward to catching up with Mike very shortly. Mike Gapin of Barclays, just around a corner, following PPI in America. Mike McKee's going to break down your data for you in just a moment. From New York City, this is Bloomberg.
So what happens is that we create some icons, we call them tags, and they have a signal within them. And when you stare at that, your eye responds to it in a particular way. So the way in which that eye response occurs is a signal that we pick up on the visual cortex of the brain at the back of the brain. So the sensor is looking for the signals we create here that come through the eyeball, through the brain, and then onto the visual cortex. Once we've got it there as a signal, we can grab that, we understand what that signal looks like, and we can turn that into a command for whatever we're trying to control. There's multiple places where we think this technology can be applied, perhaps in, I don't know, driving or commanding unmanned ground vehicles or unmanned naval vessels, perhaps providing menu selection and control within a control room environment, maybe in a nuclear power station. All those kind of things are perhaps in the bailiwick of this technology.
Wednesday, Bloomberg surveillance. The Fed decides. What's the Fed's forecast? Will they speed up tapering? Will we see earlier rate hikes? Tune in Wednesday starting at 1:30 Eastern on Bloomberg.
From New York City for our audience worldwide on TV and on radio, alongside Lisa Abramowitz and Caroline Hyde, I'm Jonathan Ferro. Your equity market down 10 on the S&P, negative 0.2%. Yields are higher by a couple of basis points on a 10-year to 143.26. With your PPI data in America, here's Mike McKee.
Good morning, John. Well, the producer price index for final demand shows that companies are still paying a lot more money for their goods, and that is not good news overall for the inflation picture. The month-over-month change, 0.8%. That's up 0.2 from last month and 0.3 higher than the expectation, which leaves the year-over-year number. Wait a minute. Excuse me. I missed the calculation there. 9.6%, which is up from 8.6%, a full percentage point higher for PPI final demand goods. Take out food and energy, and that is the number that people want to do when they're not considering what's happening with energy prices. 6.9% a year-over-year basis. It's up 0.7%. Way ahead of the October number of 0.4%. So we are seeing some significant increases in overall prices paid by companies for their factory-made goods. One note this morning, the NFIB Small Business Optimism Index came in a little bit stronger, a little bit better, but the prices charged number rose significantly. So we are seeing inflation still in the economy. It's not the T word.
A nudge lower in the equity market, not a big one, down 15 on the S&P, down 1/3%, and yields making a move, Lisa, but again, we were already there on 10s. Yields just a little bit higher, up a couple of basis points to 143, basically as you were on a 2-year, up 2 basis points to about 65.
It's compelling to me because how much is baked in and how much can companies continue to pass this along to consumers that have started to push back around the edges with respect to higher prices, and that really will be the question with respect to the consumer, but I am surprised that we're not getting more of a reaction considering that this is a significant upside surprise at a time when inflation is one of the key concerns heading into 2022, John.
Mike McKee, walk us through the Fed for tomorrow. They've got the CPI data, they've got the labour market data, they've got the PPI data. Walk me through what you're looking for tomorrow.
Well, I think a lot of people are, well, first thing you want to know is how fast are they going to taper, and the expectation is they double it. So if we get that 30 billion a month number, move on quickly from that to what are they forecasting for inflation? Remember, these guys have anticipated for the last couple of years that inflation would fall back to about 2% in the 2 or 3 year time period. Do they raise that given what's happening? And then everybody's going to want to look at the dot plot, get an idea of how fast the Fed thinks they need to raise interest rates and how far. That'll tell us something about when they might be looking to do that.
Let's begin with liftoff. Mike McKee, we can do that right now with Mike Gapin, the chief U.S. economist at Barclays. Mike Gapin, I said you were at May, threatening to move to March. You've already done it. March is the call now for liftoff. Mike, what separates you and the pack? You're at March, the pack's in the summer, June out to September.
Good morning, Jonathan and Lisa. Thank you for having me on. I think we would say it's exactly what has been just mentioned, the concern about inflation, where inflation is coming in. And I'd say it's a twofold argument for us. One is the November minutes say risk management is now the guiding principle of monetary policy. And in the extreme, that means you don't necessarily need to meet all your liftoff criterion to move rates higher. You can just be worried about the risk of higher inflation. So that's one argument. The second would be that employment report that we received last week. A very solid decline in the unemployment rate, a 1 percentage point decline in the unemployment rate since August. And we think other members will think, hey, we're probably a lot closer to maximum employment than we thought before. The economy is accelerating fairly rapidly in the fourth quarter. So Omicron concerns aside, which are certainly valid, there's a lot of momentum. Labor market progress has been healthy. If you're concerned about inflation, we think that puts March on the table. So that would be our argument.
Michael, we were just hearing from Jonathan Stoltzfus over at Oppenheimer, and he was saying he thinks it's different to accelerate the taper from saying that we're going to raise rates sooner at the Federal Reserve. What do you say in contrast to that, with your call going very much against that, given the fact that the Fed has basically been saying something of that nature until a sharp pivot in the past couple of weeks?
Right. You could do risk management to start taper, to create optionality, but then you'd kind of watch the data under your feet as it came in terms of deciding when to lift off. So risk management was about the beginning of taper, not necessarily about rate hikes. But if risk management is now the guiding principle in the conduct of monetary policy, then tapering, the pace of taper, the start of hikes, the pace of hikes, all that can be done for risk management purposes. Again, it's about the risk of higher inflation, not necessarily where current inflation is. So you could argue that a decision to taper and taper more quickly does send a signal about your willingness to hike rates. So I think it would be, my response to that would be, it's about, how much you think risk management is the umbrella over all policy choices at this point in time.
How significant is it, from your perspective, Mike, that we have seen such aggressive rhetoric from former Fed officials, including former Uber doves, like a former Minneapolis Fed President Coach Lakota, coming out this morning and basically saying the Fed is risking a 1965 type scenario where inflation looks containable and ends up not being so?
Well, I think it's a reflection of the pressure that they're getting across the board. So you saw the comments from Congress, both sides of the aisle, stating concerns about inflation for different reasons, wanting the Fed to respond to it. So this isn't, necessarily what I'd say a partisan issue. It's coming from your kind of, your traditional economists, your non-orthodox economists. It's coming from Republicans and Democrats in Congress. There is a chorus of calls for the Fed to respond to this. I personally think, or we think, the risk of a 60s or 70s style inflation story is overblown. But that doesn't mean the Fed shouldn't be responding to what they see are risks to inflation in the near term. We think inflation ultimately will come down, and the Fed will, will have its credibility maintained in terms of achieving 2% outcomes over the long term. I just think the risks of a wage price spiral are overblown, and the quicker the Fed moves, the less likely that it's to come to play.
Mike, Caroline in London here, and I'm interested in how much the other side of the Fed's mandate was, of course, inclusive jobs market overall, and that's had to be, to a certain extent, put on the back burner because inflation perhaps eats into inequality even further. But how much do you think that becomes a focus point once more?
Caroline, it's a great point, because risk management, again, just to come back to this, means you may very well be lifting off even though you might not think you're at maximum employment. And the committee hasn't really gone to great lengths to clarify to you what broad-based and inclusive means. It doesn't really even define what full employment is in its statement of longer-run policy goals. It's more of a we'll know it when we see it. So optically, it could look, difficult for them where they're raising rates, but still several million workers are out of the workforce and participation is subdued. It's not a great position for them to be in, but it's the one where they're in currently. What I would say is if inflation does start coming down rapidly over the course of 2022, then maybe they pause any rate hike cycle that they've started and kind of shift back in the direction of saying, well, now it'll be a little bit easier for us to ride out an expansion and improve labor market outcomes. So right now it's about heading off risks of inflation, but there are worlds in which they could shift back to promote full employment.
How much could the strength in the dollar be the thing that ekes away at inflation at that rapid rate in 2022?
So that's a great question, because in the last cycle, of course, any kind of movement to hike rates came with a lot of dollar appreciation, which fed back into lower growth and lower inflation outcomes. At least the Fed's shift in kind of our change in call brings our rhetoric and the Fed's communication in line with where markets are. So we're not necessarily thinking a pivot at this point or rate hikes in 2022 may bring about a much stronger dollar. So I think you'd have to have the Fed maybe moving more rapidly than the market is expecting. I don't think that we're there yet. So I think it's less likely, but certainly it's something that we're watching out for. I would say over the long term, it's part of the reason why the market thinks the terminal rate is lower, that the Fed will be raising rates more than other developed economies, which would likely keep the dollar buoyant over time. So I think it is part of the story on the terminal rate, but maybe not in the near-term performance of the economy.
Michael Capon, work with me here. Year over at 3:30 Eastern tomorrow. Yeah? Send the team home. Are we done for the year?
Pretty much, yeah.
Thanks, Mike. Appreciate it.
Wait, seriously?
Yeah. Of course.
Like, come on. What happens if something happens at ECB or Bank of England?
They're on standby.
Oh, are you?
Well, I'm the U.S. economist.
There you go.
So it doesn't matter.
Mike Capon, Barclays. The first year grads Lisa got a pay rise, which means they're going to work up until Christmas, and Mike Capon's going to go home. That's how that's going to work.
I love that.
Isn't that how it works?
I'm a U.S. economist, so the rest of the world doesn't matter.
The ECB doesn't exist.
Exactly.
The Bank of England doesn't exist.
It's true. I mean, he'll phone in too. We'll call you too, Michael Capon, if the Bank of England hikes rates.
That sounds like a threat, Lisa. Futures down 23 on the S&P. We're negative about a half of 1% on the S&P 500. Rolling over just a little bit going into the opening bout. We're down about 150 now on the NASDAQ 100, so a bit of a downdraft in the last hour or so. We're negative 0.9%. And we give up some of the move on 10-year yields. We were higher by a couple of basis points. Now up barely 1, Lisa, on a 10-year to 142.
To me, the idea that stocks might be more vulnerable to high inflation reads is interesting. Perhaps bonds have already priced in an inflationary push and a more hawkish Fed, and stocks have not really gotten on the same page. This is something you and I have been talking about, John, with respect to why stocks haven't responded more to the move that we've seen in the front end over the past couple of weeks.
You and I have clearly spent too much time together over the last couple of days. Looking forward to Tom coming back. Got this message just moments ago.
So disturbing.
Okay, my computer went crazy. Fusion done.
No.
Lisa, that is terrifying.
Absolutely terrifying.
That is absolutely terrifying.
Here's the question.
Look, just the important part of this, don't zoom in too quick. Yeah. S&P 500 futures were down 1/10, and now they're down 5.
There you go. See?
And that was moments ago.
That's what happens because, the bear comes out.
I don't know who's scaring the market more. You're part of the foe or mine. Futures down 23 from New York City this morning. Good morning. Caroline Hyde, a special thank you to you. Tom Keen's going to be back tomorrow. Coming up at the Open, David Jones of Bank of America on their fund manager survey.
Take that off.
Can we put me back in vision and just remind people of what I actually look like? And then maybe Lisa as well. Just, a refresh from New York City. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. In the northeastern U.S., officials are trying every tactic to control a surge of coronavirus cases that has emergency rooms overflowing and infection rates soaring. New York is requiring masks in all indoor places across the state. Massachusetts is sending home free test kits to its poorest areas. Hospital admissions for COVID climbed 14% in the week ending December the 9th. In Kentucky, authorities now say at least 74 people died in tornadoes last week. 14 were killed in 4 other states. Efforts have now turned to repairing the power grid, sheltering those whose homes were destroyed, and delivering drinking water and other supplies. The International Energy Agency says that relief for tight oil markets is on the way. It says there's now a surplus in the market, and the agency forecasts an even bigger oversupply early next year because the Omicron variant is impeding international travel. And the IMF warns that the British economy is headed for a mild slowdown early next year. That's because of tighter restrictions aimed at limiting the spread of the Omicron variant. The IMF is forecasting 5% growth in 2022 after a 6.8% increase this year, and it says inflation will peak at 5.5% in the spring. Billionaire Elon Musk wants to remove carbon dioxide from the atmosphere and use it to power spacecraft. His rocket company, SpaceX, is launching a program. It relies on a type of technology, direct air capture, that is still in early ages of development. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Worker perspective, a recent headline, you got Kellogg's Cereal Union says the latest agreement that they had was rejected. Deere had to finally make a union contract. How concerned are you about the longshoreman contract and union negotiations right now?
Well, we're some time away from that. The contract expires on the 30th of June next year, and both sides have told me that they'll sit down to the table and begin negotiating in May. These are always important discussions, and usually when the spotlight is on our industry. But there'll be some issues around wages. The industry is making a lot of money. The longshore folks would like to see that. Now, I don't speak for either side, but training and development of the workforce will also be key as robotics and automation are front and center. The workers cannot be left behind.
Yeah, but to that point, I mean, do you feel like the balance, though, has shifted? I mean, for so long, workers had a lot less negotiating power. Do you feel like the pendulum's shifting?
The International Longshore and Warehouse Union, which does work across 29 West Coast ports, is very strong and a democratic organization.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The world's urban areas are most vulnerable to climate change. Cities consume 78% of the world's energy, while also generating 60% of greenhouse gas emissions. By the year 2100, 85% of the world's population is expected to live in cities. 90% of all urban areas are coastal. And with sea levels rising, 800 million residents are likely to be affected. 1.9 degrees to 4.4 degrees Celsius is the projected increase in urban temperatures around the world by year 2100. By By 2050, 1.6 billion people are projected to be vulnerable to chronic extreme heat.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
The Fed thinks that neutral is 2.5. I think it might be a little higher. I think they're going to have to go beyond neutral in this cycle, given how far they've let inflation run already. So my thought is, we're probably going to be somewhere in the 3 to 3.5 range by the time we end.
The big debate on Wall Street is a Fed policy error moving too quickly or too slowly. And frankly, people cannot agree right now. That was Stephen Stanley, Emmer's Pierpont chief economist, coming out saying that they need to move more quickly based on where inflation is. Lisa Abramowitz, Caroline Hyde over in London. Jonathan Farrow moved off to his second property. Caroline, I got to say, right now, it's amazing to see how much people are looking past COVID as a possible risk factor to markets, even as what you're living is eerily reminiscent of what we saw last year.
And already affecting central bank policy here in the United Kingdom, the Bank of England doing a U-turn. Sure, they're a step ahead of the United States and other developed central banks because they were actually looking at a real rate hike right here, right now. But that's been pushed off into the long grass for the time being if we have got this immediate concern of an Omicron variant.
And in the meantime, people are just looking to Apple to become a $4 trillion, $5 trillion company. Yes. I'm looking for the next bull and to get bigger and more bullish than the next. The issue I have is how much do we just ignore the failures? Do we ignore the missteps in our trajectory upward, given that that is all we seem to be seeing these days? Barry Ritholtz, Bloomberg opinion columnist and Ritholtz Wealth Management chairman and chief investment officer, recently wrote a piece about the survivorship bias, how we certainly focus more on the winners than the losers. You were talking about Legos. Are you really very interested in Legos for this Christmas, Barry?
Well, it's not just Legos. It's pretty much anything that you could put money into and pretend is an investable asset class. So it's collectible wine and artwork and cars. And we see the winners. We see the Ferrari 275s that go for $13 million. It's easy to look back in hindsight. You forget all the other investments that didn't pan out. And so Legos is a great example. The whole Beanie Baby bubble craze from the late 90s, it wasn't that long ago. And yet people are already forgetting about it and pouring their money into the next thing. There's not a whole lot of scarcity with Legos, even if they do only a small run of a particular set. There's still tons of them. So.
Okay. But aside from the fact that we are heading into the holiday season, what's the analog here for investors in terms of paying attention to the potential for failure that's certainly getting mispriced in certain pockets, according to a number of different people?
So I'm not in the mispriced group, or at least I'm not there yet. It takes a certain amount of chutzpah to say I'm smarter than the collective judgment of the markets. Markets do get it wrong on a regular basis when things get really extreme, but look at the past decade of earnings growth. It's the best earnings growth we've seen in a century. And so the market correctly sniffed out that rising profits, rising revenues means it can support a higher level of stocks. There's another discussion about, is PE multiple the right way to measure valuation and are stocks pricey? That's a whole nother conversation, which I'm happy to get into if you'd like.
And Barry, it was interesting Lisa asked you for the analog. I'm going to ask you for the digital because you're a man who's been looking at the crypto space, trying to work ways to have exposure to spot Bitcoin via ETF-like products when they're not quite available yet. What about the infusion of liquidity that we continue to see and how that supports digital art, which is also in a collectible, or indeed crypto in and of itself?
So let's take that backwards. We'll start with NFTs, and I'm of the generation that I want physical stuff, not as much digital stuff. I actually like the old double albums that you can open up and read the liner notes as opposed to digital music. That said, there are a lot of people with a ton of profits in the crypto space, and the whole NFT world is a little bit of financial flexing, a little bit of an admission to a club. It's not where I want to put my money, but if that's how other people want to roll some of their, profits in Ethereum or profits in Bitcoin into a 600,000 metaverse yacht or a Bored Ape Yacht Club NFT, that's up to them. I would rather have the actual boat or the waterfront home than the digital version, but I guess those folks have already checked those boxes. So, yeah, to the uninitiated, it looks a little frothy, but to the people within the crypto space, it makes a lot of sense.
I mean, Lisa, did you see that fat finger that apparently occurred on one of the Bored Apes the other day? It sold, instead of being sold for $300,000, it sold for $3,000. Ouch.
Yeah, I'll be honest, Caroline, I'm dealing with this at home because my oldest son is very interested in NFTs and tries to sell me on them and sends me pictures of them. And I've tried to convince him that when he earns enough babysitting money to pay for it himself, he can go for it, but I don't really want to give him money for it. But he has a whole theory about why this is the next wave. And the fact that they're talking about this, frankly, Caroline, I understand the bull case, but I try to be a dose of reality on a daily basis.
Never be the naysayer when it comes to it. But I mean, Barry, back to your point, I mean, is that a sign of the bubble, or is it just that money needs to be put to work elsewhere? Does eventually money come out of the digital space and be put into real assets that drives them higher?
So we've started to see over the past couple of years a lot of institutional money flow into crypto, blockchain, digital, metaverse, etc. There's a lot of skepticism. There's a lot of, gee, this seems frothy. And then suddenly you have places like JP Morgan and Fidelity and other large custodians saying, we want to be involved in this. No one wants to miss the next new thing, the next great thing. And this certainly looks like it could be, it's almost a cliche to call it Internet Web 3.0. But that seems to be the positioning.
Yeah.
What the takeaway from all these people leaving their jobs and the high, not just the quits rate, but the high new business formation, which we've been talking about for a long time now, is a lot of people are finding alternative ways of earning a living, whether it's investing or speculating or starting support companies for this. There's a robust business in that sector. Whether it's going to be trillions of dollars and sustainable is anyone's guess. I don't want to bet against those guys. They're smart and savvy and pretty fearless.
Barry Ritholtz, thank you so much for being with us on Legos to NFTs, which is, I guess, the modern toy for some children who want to dabble in the market. I will say, Carolyn, high, just resetting after that higher than expected PPI print, the idea that prices are actually increasing. Again, yet another measure of how they're increasing faster than people had previously forecast. The move in yields in the bond market is fascinating. On the long end, you see yields heading lower. You see the yield curve contracting. The implication here being that the ongoing inflationary expectations will move up in the near term, which will force the Fed's hand and lead to longer term lower inflation.
I mean, once again, the flattening of the yield curve coming into focus as we worry about the longer-term growth trajectory and we focus more on the here and the now and the tackle of inflation that could get even worse from a production side, Lisa, as you said so wisely yesterday. If Omicron hits China, then what of some of the PPI numbers?
Yeah, and if you just take a look at the equity markets, the NASDAQ, I'm really struck by the idea that the NASDAQ is now down, futures down more than 1% following yesterday's sell-off, even in the face of contained yields. How much does this get turned on its head as the bulls continue to put their message out there? Coming up on Balance of Power, Jim Farley, President and Chief Executive Officer of Ford. I'm sure he will talk extensively about supply chain disruptions from New York and London. This is Bloomberg.
60 years ago, this was the site of a bitter battle between India and China. 6 decades down the line, the two Asian giants are again engaged in a bitter border dispute. The 13th round of talks have ended in a stalemate. As the winters creep into the Himalayas, both sides have reinforced, and soldiers are hunkering down. India has reinforced its positions all along the line, bringing in additional troops, tanks, guns, UAVs. Clearly, neither side are taking any chances.
It's such an interesting new world.
The world is changing.
For us, it's not about being first. It's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I don't think it's the great resignation. I think it's the great reshuffle, and people are reflecting on what do they want and how do they want to work and how do they want to live their lives.
Isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Counting down to that Fed decision from New York City this morning. Good morning, good morning. Your equity market pulling back. We're down 28 and negative 0.6%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue. One more day to go.
The Fed meeting.
Fed on Wednesday. That's ultimately the story.
They do need to act.
The Fed does need to tighten.
They are starting to act.
We're likely to see the Fed accelerate their tapering.
Double the pace of tapering.
Double the pace of the taper.
Which I think they have to do.
Yes, the tapering is coming. It's more aggressive than expected.
What the Fed is trying to do is basically buy some optionality right now.
Really giving themselves the option to hike faster in 2022 should the data support that move.
They can do it without disrupting, this upward momentum, but it's going to be tricky.
The Fed is really at an important transition point.
They're clearly walking a very fine line here.
Joining us to discuss Columbia Threadneedle's Gene Tenuzzo, JP Morgan's Clinton Warren, and Emily Rowland of John Hancock. So let's start right here with base case expectations. Emily, first to you.
Sure, we agree with the consensus that we will see a faster taper announced tomorrow. We think that it will double in size. We think it'll conclude by March, and we're watching the dot plot closely. Of course, we expect that to be revised up. We're penciling in 2 rate hikes for 2022, 3 for 23, and then 4, who knows, for 2023, but that's what we expect. So the Fed's really been pushed into a corner here. That CPI data that we saw, 6.8%, highest level in 4 decades. PPI this morning coming in at an all-time high by some measures. Really, the Fed's got to act here. The most important thing that we're watching, though, is the shape of the yield curve. So the short end's telling the Fed, you got to go. We know that well.
I think this is such an important point, Emily, on the yield curve, because 2s10s has been flatter. So just hold that thought if you can before I bring in Clinton Warren. Clinton, can I get your base case as well, please, sir?
We're in the same camp. We think that tape will accelerate end in March, watching the dot plots as well, 2 to 3 hikes in 2022. But we have to remember that it's going to be completely data dependent on when we finally see liftoff from the Fed. And there's going to be a ton of data points between now and that point. But data like we saw today in PPI, data like we saw with CPI last week will encourage the Fed to move quicker than the market has expected. There are some things that could delay the Fed's movement. Maybe if there is good base inflation decreases, labor force participation increases, and we have a full labor market, it would give the Fed the ability to delay, but it can't as everyone else. Increase in tapering 2 to 3 hikes in 2022.
Got a decent idea of where consensus is. Gene Tenusa, this from Deutsche Bank. Our baseline still expects a doubling of the taper pace in December. QE ends in March. Rate hikes maybe in June, a couple through 22 into 23, then pause, and we think about balance sheet reduction. Is that basically in line with your thinking as well, Gene?
Yeah, John, it's similar. You know, I think what we know is that monetary policy works with long and variable lag. So yes, it's likely that at the meeting tomorrow, they double the pace of taper, so they're done sometime in Q1. But it probably takes, in our research, about a year after they're done purchasing assets for that really to affect the economy. So I think we're going to have a lot of conversations before we really know if it's worked. But yes, for tomorrow, we think they double the pace of taper.
And back to you, Emily, and forgive me for cutting you off. A bit of a delay on my end, so forgive me for that. We can go back to that yield curve call of yours. When we started the last rate hiking cycle back in late 2015, that yield curve, the spread, the difference between 2s and 10s was north of 120. Right now it's sub 80. Does that matter, Emily?
Yeah. Well, I think it certainly does. And by the way, John, you can cut me off anytime you want. You are the leader of the show here. But I do think it's important to think about those prior examples. The Fed had a lot more room to go. Right now, 2, 3 rate hikes, they're done, and they risk inverting the curve. So I think the Fed is watching this. They're acknowledging the fact that the longer end of the curve is reflecting more modest growth expectations as we head into next year. So the Fed holds the keys to this cycle. If they move quickly to stomp out inflation, they may risk cutting the cycle short. If they decide that they can be a little bit more patient, which I think is looking harder and harder, they have the ability to extend this cycle. So I think we're setting up for some, hawkish moves into next year.
Well, let's talk about where the hawkish surprise could come from. Citigroup weighing in on that, saying a true hawkish surprise would be Chair Powell signaling openness to a more aggressive pace of rate hikes or earlier balance sheet reduction. Gene, I want to come back to you on that, where the hawkish surprise would come from for you in terms of the sequencing, this conversation about balance sheet reduction. Is that something you're looking for?
It is, but I don't think we're going to get information on that today. I think the point on the curve is real. The Fed cares about it, whether they really should or not. And when we get to a point next year where the balance sheet, where they're done purchasing assets, I think if the curve is as flat as the forward suggests it will be, the Fed may be in a real position where they decide to let the balance sheet run off or even actively reduce the balance sheet rather than raise rates. I think a steeper curve, in their view, is a better signal for the economy. I do think it's a misread, though. I think if you look at really the sort of shadow rate or the implied rate for Fed funds right now, it's deeply negative. So if you take that into account, sort of the true measure of the yield curve, we would argue, is actually quite steep right now.
Let's begin with this equity market about 25 minutes away from the opening bell. We're down about 27 on the S&P. We're negative 0.6% on the Russell, down 0.5 on the NASDAQ, rolling over 165 and negative 1 full percentage point. Let's take the rates conversation and talk about what it means for the broader equity market, for risk assets as well. Jonathan Goldberg, Credit Suisse, put this together in the last 24 hours. Really interesting quote. Over the last 4 cycles, 94, 99, 2004, 2015, the S&P 500 gained 9.5% in the 12 months prior to the first hike, 26% over the subsequent 3 years. The real damage from higher rates tends to occur later in the cycle when tighter policy flattens or inverts the curve. We are far from that point in the mind of Jonathan Goldberg. So a two-piece story here. What do rates mean for the equity market? What is a rate hiking cycle? And Clinton, I want to come to you on that. Just the work of Jonathan Goldberg. 99, 94, 2004, 2015, the 3 years after we started, they were good years. Is this different?
Well, I mean, I think the point that we were talking about earlier on the 10-year is an interesting one, especially as it deals with the mortgage rates. It's still very stimulus. We see a lot of clients out there getting new mortgages, refinancing. It's still pushing inflation and growth higher. We don't think the short rate becomes punitive until way into the cycle. But the consumer has the capacity and the willingness to keep this economy going. Household net worths are up of housing, debt services is low, balance sheets are strong, even though some of those saving rates have come down. So we think the 10-year needs to move. If not, that's going to be stimulus for growth and for inflation. but the short end doesn't become punitive for a while into the cycle.
The 10's at 138, or rather 143 right now. 7's at 138. 2's at about 66 basis points. Emily, I want to put that Jonathan Golub quote to you as well. Just your reaction to it. Can we compare this cycle, this rate hiking cycle before it even begins, to what we've seen over the last 20, 30 years?
Absolutely, equities can handle higher rates, and I agree. We've seen that happen historically. So remember, when the Fed is tightening policy, that means that the economy is accelerating, and that's clear to us right now. We just had services PMIs hit a new all-time high. The leading economic indicators actually stopped decelerating in October, and we expect to continue that momentum right now that we're seeing in the fourth quarter. We also have to remember that if you're concerned about inflation into 2022, equities are your best hedge against inflation. Equities actually tend to do quite well in periods of elevated inflation because their earnings are nominal. So we think equities can do just fine into next year. We just think it's going to be trickier to find the ones that are going to work. We would fade your more cyclical parts of the market, and we would start to embrace quality more as we head into next year.
Thinking about the beginning of this rate hiking cycle, any journey's three parts, right? The lift off, the start of it, the end point, the destination, and the speed, the time it takes to get there. We're talking about liftoff maybe after Q1 into the summer. Barclays going with March. We're talking about a destination sub 2% for a lot of people. Let's talk about speed. Gene Tenuso, this came from a viewer, a terminal subscriber, asking the following question. On the Fed going 50 basis points right out of the gate, can they prepare the market for it? They'd have to use the rhetoric that they're not tied to 25 basis points, but it could send a message. Gene, do you think they're tied to incremental 25 basis point moves?
I think it's going to be hard for them to break the incremental streak that they've been on. And we've seen that for the last several cycles. But I think your point is a good one. Speed kills, and that matters in interest rates, right? It's not just about the level. I think Clinton made a very good point. The level is far from punitive at this point for consumers and for companies. But it's that speed with which rates are increasing that really starts to dent confidence. We saw it a little bit in the first quarter of this year as the 10-year rate was really starting to shoot higher. I think that's really where you damage confidence. I don't think the Fed's going to go in 50 basis point increments, but even if they started to go 25 basis point increments every meeting, that would still be a shock to the market.
Clinton, you started that conversation. You inspired it by talking about the move in the front end. At these levels, not punitive, given the fact we're still deeply negative in real terms. But can you comment on the speed, the kind of expectations you have for next year and beyond?
Yeah, I mean, I agree with Gene. I mean, it's all going to be relative to the market expectations. So if the Fed were to go more than 3 times next year, I think that'd be punitive to the market. If the Fed were to go at 50 basis point clips as opposed to 25 basis points, I think that'd be punitive. But it's all based on market expectations. And once again, I just want to stress this point. There's going to be so much data that then, if we continue to see inflation running high, that may encourage the Fed to move quicker. But I'm kind of in the camp that 25 basis points is what's priced in, and that's what the Fed's going to do.
Clinton, Gene, and Emily, sticking with us, just want to bring you this story from Narayana Kocherlakota, the former Minneapolis Fed president. He's running on Bloomberg Opinion today. We've heard from the likes of Dudley, the likes of Lacker, former Fed presidents who are sounding really hawkish. If you remember the former Minneapolis Fed president, he was incredibly dovish when he ended his term back in 2015. This is what he has to say on Bloomberg Opinion today. The Fed faces a troubling 1965 parallel. If officials don't announce a much more aggressive path of interest rate increases than I expect they will, their passivity will risk a repeat of the great inflation of the 1970s. We'll pick up on this point in a moment, but it's fascinating to see what the old guard are saying right now on the likes of Bloomberg Opinion with Dudley and now Kocherlakota, who are calling for this Fed to do a whole lot more. A headline which may be reminiscent of the 1970s on crude. Let's bring in Abigail Doolittle. Hey, Abby.
Hi there, John. Well, indeed, we do have a headline crossing saying that President Biden is not considering reinstating the crude oil export ban. This, according to Granholm. And on this, we do have crude oil slipping just a little bit down at this point on the session, about 1.3%, but really taking a bit of a nosedive on this headline. Again, President Biden is not considering reinstating the crude oil export ban, and at this time, crude oil is taking a negative stance around that headline.
Abby, thank you. Coming up on the program, we'll take it down to D.C., the president struggling to find a breakthrough.
There's an overarching reality in D.C., which is things appear impossible right up until the point that they are inevitable. And I think that that's where we are right now with this Build Back Better package.
That effort gets pushed out into 22. The latest down in D.C. next from New York. This is Bloomberg.
extra $1 trillion in spending, not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we frankly have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the President's agenda, what I like to call the big deal. But Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of health care, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
The president is going to speak, looks forward to speaking directly with Senator Manchin about and making the case for why the president feels this legislation should move forward. Senator Manchin has been in touch over the course of the last several weeks closely with senior members of the White House staff, and we expect this just to be a continuation of that conversation.
Senator Joe Manchin emerging from a phone call with President Biden, still uncommitted to voting for the economic agenda by the end of the year. Manchin continuing to raise concerns about inflation, telling reporters the following: inflation is real. It's not transitory. It's alarming. It's going up, not down. And I think we should be more concerned about geopolitical fallout. From D.C., joining us now, our Washington correspondent, Bloomberg's Joe Matthew. Morning, Joe. Is this one for 22?
Morning, sir. It's starting to look more like it. That's the conventional wisdom here in the Capitol this morning as we watch the calendar as closely as we do these briefly worded statements that came out last night following the meeting from both Joe Manchin's office and the White House, referring to productive talks that will continue. But to your point, Jonathan, it was what he said before the meeting, not just that, but referring to last week's inflation data and looking ahead to this week's Federal Reserve meeting. He mentioned both and used the quote, "We are seeing things unfold that allow us to prepare better," seemingly acknowledging this growing argument around him about inflation here, something that he's been talking about since the middle of last summer before it was on the front of everyone's minds. Remembering as well the memo that he signed with Chuck Schumer last summer that at the very top put a cap on spending of $1.5 trillion and called for an end to quantitative easing. Now, as far as the calendar is concerned, Senator Chuck Schumer, the majority leader, doesn't have a lot of time to play with here. The Senate's voting on the debt ceiling today, expected to vote on the annual defense budget tomorrow. And Jonathan, we still have not heard from the Senate parliamentarian, which will, of course, have to rule on what goes in and what comes out of a final version, reminding us again that there is no actual bill yet for lawmakers to vote on, John.
These are big issues on the policy front. I'm well aware, though, Joe, where you are right now, we're still on January 6th of this year. Is that a fair characterization of the conversation down in D.C. at the moment, Joe, that the focus really is still on January 6th?
Well, look, it's a big deal, and this happened last night as well, this vote to recommend, at least on the committee, Mark Meadows, to the Department of Justice for criminal contempt charges. The House is expected to follow on in full there. Pretty remarkable stuff, I will say, last night. We haven't seen all of these documents, Jonathan, but Mark Meadows has already given up a lot to this committee, including text messages from Fox News anchors, from Donald Trump Jr., all reaching out to him that day in the middle of the attack on January 6th, asking him to get the president on TV and bring this to an end. The chair of the January 6th committee, Benny Thompson, referring to the fact that Mark Meadows stopped talking to the committee the same day his book was published, and they want to hear a lot more.
We can confirm that Joe and I were not advising the administration at that time. Remarkable stuff. Joe Matthew down in D.C. Looking forward to the radio show a little bit later. Sound on Bloomberg Radio. Just on the policy front, BTIG's Isaac Boltanski expecting the Build Back Better package to be finalized, but with a different price tag. Take a listen.
They will narrow the bid and ask between Senator Manchin and Senator Schumer and the rest of the Democrats over the next few weeks, and we're going to get to a lower number, something closer to 1.3 to 1.5 trillion, rather than the 1.75 that cleared the House a few weeks ago. When you're arguing about specific issues like we are right now, you're very close to the goal line.
Back with us, Gene Tenuzzo, Clinton Warren, Emily Rowland. Emily, 12 months ago, this was a massive conversation. The big effort down in D.C., how much of a fiscal effort we would receive from Washington. I'm looking at the outlooks. It's crystal ball season, you know that. Pouring through all of it. Hardly gets a mention anymore, Emily. Why?
The reason in our mind is because whatever we do as far as infrastructure spending simply is not going to compete with the fiscal bazooka that we saw in 2021. You pour $5 trillion in stimulus via direct payments into the economy. The Fed doubles the size of their balance sheet. That's an almost warlike response that we're extremely unlikely to see again. Whatever infrastructure package we see will likely spread out over a number of years, and it might actually be challenged by some of these supply chain constraints that we're seeing as a result of COVID. We just don't see it providing that stimulus to the economy that we've seen over the past year. Those comps are just going to be way too hard to beat as far as stimulus goes.
It's amazing to me to see nominal growth absolutely on fire, to see inflation at 6.8%, to see the work that's been done in Washington over the last 12 months, let's make it the last 18. And Gene Tenuzzo, to see the 10-year yields up today by 3 basis points, but still at 145. And Gene, I was reflecting on 2016. Do you remember that summer when we broke down through 140 and we were thinking about a global recession started by a downturn in China? That was a breakthrough 140, and that was a record low on a 10-year yield. And here we are, Gene, at 145. Can you make sense of it for us?
Well, yeah, it was Brexit that took us down to those lows in 2016, and really the economy had started to accelerate shortly after Brexit, and the election just happened to be a catalyst that took us to higher yields. And who knows what that catalyst could be, but I do think, if this economic momentum that we've seen post the Delta wave continues, I think that we are in a position to move towards higher yields next year. And it could be that one of these smaller bills could be the catalyst in Washington. But I'm more with Emily. I think the scale of the bill that's being discussed now seems sort of too little to really move the needle.
Clinton, what is the catalyst for higher rates at the long end?
Yeah, I mean, hoping some of this tapering will help push it, but I don't think that's going to get it to where we have it estimated. We think it can move to 2.1 by the end of 2022, which is down from our forecast at the beginning of this year. So, I mean, it's completely frustrating to see that it has not moved where the market has previously had it priced in. Back on the bill, I agree with Emily as well that the real impact of the stimulus of the fiscal bill won't have any impact until 2, 3, 4, 5 years down the road. I think if the Congress does not get something passed in the first quarter, that will be damaging to the markets. If they kick it down the road anymore, that will be damaging to the markets. But the real impact and to the S&P 500 won't really have a big impact until farther down the road. One concern I do have is there's all these workers out there looking for jobs, and when we have a big fiscal package this, where are we going to find the folks to help implement all the things that the administration has laid out? So that's one of the things that I'm following. Will this exacerbate some of the issues we have in the labor market at this point in time?
I've lost track of job openings, Clinton. I think well through 10, 11 million now in America. Emily, I want to finish there. How we resolve these supply-demand imbalances. Morgan Stanley writing the following: we worry that increases in supply will reveal the severity of double ordering, which we believe is pervasive across most industries. They go on to say, the result will be a shift inward of the demand curve and a return of discounting at a time when many businesses are counting on pricing to offset the higher costs they're now having to absorb. Just heard me read through that, Emily. What's your initial reaction to it?
I think it's right. We just saw the biggest mismatch between supply and demand that we will probably ever see in our lifetimes. And to think that we're going to get that balance right off the bat is just wishful thinking. We're going to probably see things go the other way before we get back to that correct equilibrium. And so there's been a lot of major distortions in this market, whether it comes down to labor supply, whether it comes down to demand for goods and services, and whether it comes down to supply and all these supply chains getting reconfigured. So I think that's really important to think about. And it's another reason that we have a more modest outlook or moderate outlook for growth and inflation, heading into next year. That also translates into our view on the 10-year Treasury, which we actually see simply chopping around over the next year or so.
Emily, Clinton, Jean, sticking with us. Coming up on the program, the morning calls, and we'll discuss some breaking news on the Omicron variant as well. And then we'll talk about the race for $3 trillion on Apple. From New York City, this is Bloomberg.
提前的就是步入工作岗位，然后对这个工作更加熟悉，然后调整好心态，就能够在赛时去一个更加自信、更加昂扬的一个姿态去迎接来自世界各地的代表团的外宾们。
5 minutes away from the opening bell, we pulled back a little bit more. We're down by about 0.75% on the S&P, down 0.7% on the Nasdaq, down more than 1% right now, negative 1.2% on the Nasdaq 100. That's the price action here in the morning calls. We start with Evercore, downgrading Dow to inline, $63 price target. The analyst highlighting the stock's rich valuation and weakening PC demand. Next up, Goldman Sachs downgrading Ralph Lauren to sell from a buy. The analyst turning bearish amid continuing supply constraints and a lack of upside catalysts. That stock is negative 5.1%. And finally, B of A and Evercore raising their Apple price targets. Evercore naming Apple its top pick for 2022. Bank of America's 210 price target matching the highest estimate on the street. That stock at 175.20. Coming up, Pfizer pulling back from record highs after publishing new data on its experimental COVID medication. That conversation and the opening bell is up next. From New York City, counting you down to a Fed decision from New York City. This is Bloomberg.
Urban areas are most vulnerable to climate change. Cities consume 78% of the world's energy. while also generating 60% of greenhouse gas emissions. By the year 2100, 85% of the world's population is expected to live in cities. 90% of all urban areas are coastal. And with sea levels rising, 800 million residents are likely to be affected. 1.9 degrees to 4.4 degrees Celsius is the projected increase in urban temperatures around the world by year 2100. By 2050, 1.6 billion people are projected to be vulnerable to chronic extreme heat.
For breaking news, the world turns to Bloomberg.
Big news, the United Arab Emirates will switch its weekend to Saturday and Sunday. The UAE is breaking rank with the rest of the Gulf region.
Now we are aligned with the world economies.
The working week will be 4.5 days, with Friday, a holy day in Islam, being a half day.
Positioning itself as being an international hub.
I haven't once seen this as a gap or a concern by international investors.
The interesting thing will be to see how the private sector does respond.
The power of Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
From New York City, about 23 seconds away from the opening bound, distracted by Andrea Bocelli at the NASDAQ. We'll try and make sense of that for you. On the S&P 500, futures positive 35, advancing 0.75% on the NASDAQ 100. We're up by 1.2%, off by 1.2, declining going into the opening bound. There is the bound for you. Switch up the board and get to the bond market. Your 10-year yield up 3 basis points to 144.62 on 10s. In the FX market, a break of 113 a little bit earlier. Euro dollar 112.96 now, positive just 0.1%. Crude pulling back at 70.22, down $1.10. We're negative 1.54%. At the opening bound, then about 15 seconds in, we declined on the S&P 500 by 0.5%, adding to the losses of yesterday and pulling further back from all-time highs going into that Fed decision. Information technology leading the way lower, down 0.9%. Some relative outperformance in the defensive parts of the equity market, as you might expect. Utilities just about positive. Consumer staples as well, positive by just 0.03%. Counting you down to Chairman Powell and that FOMC rate decision tomorrow. We heard from Bowersock's Emily Hill expecting the equity rally to continue amid a tightening cycle.
I think we could end up with a pretty benign environment for equities. And I think that in part because, yes, the bond market is not overreacting to the inflation threat. We still have very significant amounts of liquidity in the markets. And, I think what we're going to see when we start the taper, as even if we expect interest rates to rise slightly, there's really nowhere else to put your money at this point.
Back with us, Gene Tenuto, Clinton Warren, Emily Rowland. We've got a down morning, guys. We're down about 0.7 on the S&P, the NASDAQ off by more than 1 full percentage point. Clinton, you talked about the moment when we could see some problems. We touched on it earlier. I want to build on it now. Do we have to see a real rate get positive? Do we have to get back to, say, neutral, which is where we had problems last time around at the back end of 2018? When do you see those problems coming?
Well, let's remember, just a short while ago, we had some really big headlines. We had the pandemic kind of spiking back up with the Omicron variant, and we also had the Fed coming in with a more hawkish view. And the market showed some volatility, but we didn't see a pullback greater than 5%. So with these two big headlines, the market was very resilient and still moved forward. And it's interesting being on a trading desk, we had clients calling in historically when the market pulled back 10%. And then there was clients calling in to buy at 5%, and now it's 2%. It seems like any 2% move or so, clients are getting excited because there's a fear of missing out. So, I think the market continues to move forward for things we talked about earlier, consumer, strong corporate balance sheets, et cetera. But I don't think rates are going to be punitive now or in the short term.
Emily, just how resilient has this index been this year? The S&P down 0.6%, but for all the volatility, we're a couple of days away from record highs.
Yeah, it's pretty remarkable, John. You know, I think the important thing to remember here, and we talked to so many investors who are worried about, you know, valuations, but really the most important part of that equation to us is earnings. And S&P 500 earnings came in at 45% year over year. The market's not even up that much, right? So we've seen this incredible ability of corporate America to come back with huge resiliency coming out of the pandemic, and that's been played a really important role. Of course, the economy continues to roll on. We already talked about services PMIs hitting a record high. So the economic support is there, the fundamental support is there. What I think we really need to remember here is, you know, Clinton mentioned volatility. We haven't even had a 5% correction. So smooth, you know, calm seas make bad sailors is the really phrase we've been thinking about. And investors continue to get rewarded for throwing money at unprofitable companies, for, you know, things like meme stocks. You know, we just think it's harder to get rewarded for taking those risks into next year, even though we do have a positive view on the equity markets. We do think that fundamental support is there. We just think you got to be a lot more careful about taking risk.
The problem is, though, Emily, to extend your reasoning there, those bad sailors have got a lot of gold chains, haven't they? They've made money just for staying in the equity market. How do you condition someone to believe that maybe you have to pull out?
Yeah, I mean, I don't think it's an easy job to do right now. Again, you've been rewarded. It's almost been impossible to take enough risk to keep up in this market. And I think, you know, we've been conditioned to that element. And I think it's important to remind investors that volatility is a thing. We're about to get away from or see this incredible fiscal and monetary stimulus fading into next year and return to more normal environment. Now is the time to position for the mid-cycle environment. We want quality companies. We want technology. We want companies with great balance sheets, good free cash flow, great return on equity, ability to maintain margins as we move into the next phase of the cycle. And the final thing I'll say is, I think it's interesting that these more defensive areas, staples, utilities, REITs, have been outperforming over the last month. Now, this may be related to COVID developments. Certainly that could be the case, but it also could be the market sniffing out that this cycle might be a little bit shorter, and it's maybe time to start thinking, again, we're not ready yet to get more defensive.
Maybe that's what's in the bond market as well. For many other people, they're looking at the situation at the moment. They see very loose financial conditions and a Federal Reserve that is still adding accommodation. Gene, a quick one for you. This from Mike Wilson at Morgan Stanley. Tapering is tightening for the markets, and it will lead to lower valuations like it always does at this stage of any recovery. Can you respond to that, Gene? Is tapering tightening because that tapering is going to accelerate?
Tapering is tightening, John, and you said the key word or phrase, which is financial conditions. We have to remember the Fed didn't stop easing when they stopped cutting interest rates. And they were purchasing not only treasuries, MBS, corporate bonds, even high yield. And that's all about accommodative financial conditions, which means that at some point, if they need to address an inflation problem, they need to tighten financial conditions, which means the gradual approach to very incremental rate rises doesn't cut it, and you actually need to intentionally widen credit spreads. Not a conversation we need to have right now, but it's a scary conversation we may need to have next year.
A conversation, no doubt, we will be having at some point. I just have no idea when that's coming, of course, because I don't make any calls. Pfizer down by about 0.5% in early trading, publishing some new data on its experimental COVID medication. The CEO, Albert Bourla, saying the following: emerging variants of concern like Omicron have exacerbated the need for accessible treatment options. We are confident that, if authorized or approved, this potential treatment could be a critical tool to help quell the pandemic. With more on this, here's Abby.
Hey, John. Well, before talking about that solution from Pfizer, we do have some breaking news out about 10 minutes ago and a read spike on the Bloomberg terminal. And this has to do with a headline that Italy is said to introduce mandatory testing for travelers from other EU members. Now, this is similar to something that France did last week. Portugal, one EU member, to require testing from travelers from other EU countries. So some fragmentation in the EU, of course, having to do with this new variant. Italy yesterday extending their state of emergency until March 31st on the variant. So it's all about this new variant. Now, the good good news relative to Pfizer, relative to that pill, but also their two-dose vaccine. That two-dose vaccine is, in fact, 70% effective against hospitalization, but only 33% effective against Omicron. And you can see some weakness right now here for these vaccine makers. This, of course, was after a big rally yesterday. But relative to that pill, it is 89% effective against severe disease and death. So that is certainly good news there relative to that pill. But relative to death overall on a global basis, it is ticking higher. On a 7-day basis, it's a bit higher than 7,800 deaths per day, a very sad, tragic figure. And there's some thought, as you know, John, that the booster could be the real solution here. A third shot in the UK, they are leading those efforts. 28% of the population is boosted. It's going to be very interesting to see, of course, how all this plays out. But again, Italy is said to introduce mandatory testing for travelers from the EU, really emphasizing the gravity of this Omicron variant.
That number in the UK keeps climbing. There's been a massive push over the last week. Abby, thank you. Looking ahead to next year, your S&P 500 2022 forecast at the top of the pile, 5330 over at Oppenheimer, BMO at 5300, Deutsche Bank at, I think, 5250, Credit Suisse at 5200. Interesting that JP Morgan's at 50-50, but Marko Kolanovic, I think, has got one of the most constructive views for next year on the economy. He says the following: 22 will be the year of a full global recovery, an end of the global pandemic, and a return to normal conditions we had prior to the COVID-19 outbreak. This is warranted by achieving broad population immunity and with the help of human ingenuity, such as new therapeutics. Now, Gene, I want a response from all of you on this call that's coming out of JP Morgan and the investment bank, because, Gene, this sounds a little bit like some of the calls I heard 12 months ago when we had the efficacy data in early November. 22 will be the year of a full global recovery. Gene, do you agree?
Well, that sounds like words of a doctor, not a banker. I hope that's true. Certainly there's been a lot of developments both in how we treat COVID, not just how we try to prevent it. And I think those things will help us move forward. But it's really hard to tell at this stage. And, here we are at the end of 2021, still dealing with a virus named after 2019. So, it's really hard to have that degree of confidence at this stage.
That is such a good point, Gene. And I really hope to God we're not at the end of 2022 still talking about the same thing. Clinton, Warren, your take, please.
Yeah, I just feel for all the families that are stricken with the pandemic and society as a whole. It does seem, though, that with each variant, the economic impact does become more minimal and has a lesser effect on economic conditions. So I'm hopeful that in 2022, as different variants come, there'll be less and less and less, and science will continue to evolve. And I believe in science, and I believe in what the drug companies have been able to do. So I'm hopeful that we will get to a full economic recovery in 2022.
Emily Rowland, final word. Not hope, but what do you expect?
Yeah, I think that, we've seen this divergence in terms of the degree to which you've seen more heavy-handed restrictions by different parts of the world. Clearly Europe implementing, some degree of lockdown, some degree of restrictions. We're seeing China take a very draconian response to COVID. In the U.S. here, we were implementing ways to learn how to live with it. And that's one of the reasons we've continued to see economic growth in the U.S. outshine the rest of the world. And we expect that in 2022 as well. We have a better economic growth trajectory here, better earnings growth trajectory reflecting that economic backdrop that's solid. So we think that's one reason to continue to embrace U.S. assets into next year.
Emily Rowland, Clinton Warren, Gene Tenozzo, and to all three of you, can I just say thank you for your contribution to this show this year. You help make it what it is. Thank you very much. Gene, Clinton, Emily. Coming up, investors preparing for Fed tightening.
Even though folks have known about this, they've been preparing for it, I think there's a difference in terms of the actual effect in markets over the next several months.
The latest fund manager survey out of Bank of America is up next. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need. Compare financials, find people, analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The antibody responses produced by this vaccination is able to potently neutralize the virus and a number of variants of concern. A lot of the vaccines being developed currently require super cold storage. One of the great advantages of our patch is that we're able to remove the cold chain. We've been able to stabilize the vaccine on the patch for at least a month at room temperature and a week at 40 degrees. So this makes logistically vaccine rollout a much simpler proposition, removing the cold chain from transport.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Fed has turned really hawkish.
This more hawkish tilt.
The biggest, I guess, sting in the tail. They're getting really aggressive.
Hawkish scenario. We're all of a sudden having to digest.
You kind of want to be de-risking in the next couple of weeks.
Just one day to go. Investors positioning for the Fed's final rate decision of the year, a shift well illustrated in Bank of America's latest fund manager survey. They write the following: hawkish central bank sparks surge in cash and more defensive asset allocation. If the December FOMC is dovish, then crypto, unprofitable tech, banks and emerging markets would rally. If hawkish, cash stays cash. Let's bring in Kaylee Lyons for more. Hey, Kaylee.
Hey, John. Well, on those cash levels, cash allocation was the highest in the survey, going all the way back to May of 2020, while equity exposure was cut to the lowest since October of last year. And it's hawkish central banks, as you said, that really top the list of tail risk that investors see, actually at the #1 spot for the first time since May of 2018. And that goes hand in hand with #2, which is inflation. And you also have the COVID resurgence, asset bubbles, and geopolitics as potential causes for concern. But just to focus in on those two top risks a bit more, on the hawkish central banks point, about half of investors surveyed expect the Fed will hike rates twice in 2022. That's a greater share than saw that back in November. And the share expecting one or no hikes actually shrank in the month of December. And we have to put that together with the survey findings on inflation. 55% of respondents still say it's transitory, though that's down slightly from November, and 36% view it as permanent. And finally, as for what fund managers see ahead in terms of returns for 2022, EM equities are expected to post the best ones. That's followed by the S&P 500, and then two commodities, oil and gold, make the list. And #5 in terms of best returns, John, Bitcoin. I'm just going to leave that one there.
We can leave that one right there and pick up on it in just a moment. Kaylee, looking forward to the close a little bit later. Kaylee Lyons getting some rest this week, filling in for Caroline Hyde. You enjoy that, Kaylee.
Thank you
I've
very
forgotten
much.
what sleep is like. Thank you very much. Sentiment shifting in the defensive side in December, but the survey also highlighting the following: investors are very cautious, but few outright bearish. David Jones of Bank of America joins us right now. Now, David, you're perfectly positioned to help us with this fund manager survey. Typically, when you see cash rates go north of 5%, that's a buy signal. But what we've seen is an equity market still climbing to all-time highs. So, David, walk me through how that number helps in any way at all at the moment.
Yeah, you know, it is interesting, and thank you for having me. What we're seeing is really very much a reaction to the repricing of central bank rate expectations. We're seeing that people are starting to react more to the idea that central banks are going to have to be more aggressive going forward. And you can see that throughout this survey. You know, the cash is very much a reaction to that, but we don't see the other key supports in place for a very pronounced rally following, you know, the central bank decision tomorrow. Instead, what we think is that if the Fed is more dovish than expected, we could see a boost to perhaps some of the more speculative aspects of the market, crypto, unprofitable technology companies, those sorts of things will probably rally. And that is what's probably most, what flows out of that cash under assets under management figure.
David, what's interesting to me as well, just pouring through the fund manager survey, when I speak to people on any given day, there's a fear of a policy mistake, a Fed going too quickly, inflation not getting out of control, but remaining at elevated levels. And I'm pouring through this and looking at what the respondents have told you guys. 55% still think inflation is transitory, and a net 33% expect lower CPI over the next year, the most since 2012. You look forward on expectations for growth, earnings margins, they all continue to stabilize and or improve slightly after the big drop in the fall of 21. These are the numbers, the quotes I'm pulling out of your work, David. It just seems to me that the conversation we're having, you and I, the conversation I have with pretty much everyone on any given day, is a little bit different to what I'm seeing just in terms of expectations.
Well, what we're seeing is that investors are very much expecting that the Fed is in control of it. They think that they're going to see the Fed complete its tapering by April. On average, the expectations for the first hike in July, and they expect 2 hikes in 2022. The expectation is that the Fed is going to be able to manage a sort of soft landing in terms of inflation expectations, that they're going to be able to bring inflation under control. 33% on net expect inflation to be lower next year in 12 months than now, and that's the lowest since 2012. So the confidence is there that the Fed is going to manage it, and you can see that in the asset allocation.
You can see that in some ways in pricing as well. So if that's the consensus view, and to some degree a lot of this is priced, David, you always use this, like other people use this as well. What would you lean against, lean the other way, when you look at some of these numbers, some of these calls?
Yeah, well, you know us. We're instinctually contrarian. So what is great about the FMS is that it tells you what is priced into the market. And our expectation is that the Fed is actually going to have to be more aggressive than the consensus out there. We think that the Fed is going to hike more, certainly more than the 2% that our respondents think. We think they're going to have to go faster. And we think that this is going to eventually have a knock-on effect on growth, on profits, and on margins. You know, we think that unlike the theme coming out of the survey, we think there's going to be a pronounced slowdown in the second half. And for that reason, we favor defensives like staples and utilities.
So out of the 3 top crowded trades right now, number 1 long tech, 2 long Bitcoin, 3 long ESG, which one would you short, David?
Well, you know, I would probably go with that first one. You know, that is the one that is perhaps the most crowded.
And when you expect higher rates too, could have some difficulty there. David, thank you, sir, as always, for doing this on every single month with us with the Fund Manager Survey. David, thank you for everything this year, sir. David Jones there of Bank of America. Let's turn back to this equity market. Down 17, 18 points, negative 0.4% on the S&P, falling a little bit further back from all-time highs with your sector price action. Here's Kriti Gupta.
Well, good morning, John. Red on the index level, but of course on a sector level, you do have a few in the green. Financials, materials are up in the early trading session. You do have to the downside real estate and consumer discretionary information technology, essentially at the core of it, big tech dragging the market lower, except for one of your major upside movers, and that is going to be Apple. Analysts just getting more and more bullish. The latest, Bank of America upgrading the iPhone maker to a buy on the revenue opportunity from virtual reality products. We should talk about not just tech here in the States, though, but tech across the Pacific and into China. We know Chinese tech has been under pressure this year with the regulatory scrutiny. Chinese ADRs down broadly this morning after an additional broad sell-off in the stocks and bonds of Chinese property firm Shimao after a deal in that flagged corporate governance issues and then again bled into broader sentiment. On a year-to-date basis, the NASDAQ Golden Dragon Index down 42% in 2022. Let's see if that regional divide closes, John.
Kritik, great work as always. Kritik Gupta on top of the market through the day on Bloomberg TV and radio. About 23 minutes into the session, we declined 0.4% on the S&P. On the Nasdaq, down a little more than 1%. On a 10-year yield, a bit of a pop this morning, up 4 basis points on 10s, up 5 on 30s. The curve just slightly steeper, 2 still doing some work, up 2 or 3 basis points on 2s to about 66 basis points. Coming up, the market-moving events you need to be watching. That'll be next in our trading diary. From New York City this morning, good morning. This is Bloomberg. City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims front.
How are you thinking about those dynamics?
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation. And we believe that the Q3 was the quarter that was most affected.
at Bloomberg.
And 25 minutes into the session from New York City this morning. Good morning. Another morning of losses, potentially another day of losses. A day of losses yesterday, some negative follow-through into today. We're down 0.4 on the S&P, down 0.2 on a Russell. On the Nasdaq, we're down a little more than 1%. This from Cameron Krice on Bloomberg in his column this morning. Macro man asking the following question: how can the Fed be hawkish if everybody expects it to be? Switch up the board and get to the bond market. Let's talk about it. Are they hawkish in the dot plot? Or are they hawkish with the balance sheet? Do they start to talk about the sequencing of policy and include in that balance sheet reduction? Some questions we can ask through the next 24 hours. Right now, up 3 basis points on twos to about 66, still short of the highs of the year there. And your 10-year, after rolling over yesterday, a little bit higher today, up 4 basis points to 145.48. That's the price action. Let's get you to your trading diary. China releasing retail sales, industrial production, and property investment data at 9 p.m. Eastern. U.S. retail sales coming up tomorrow, almost forgotten because we have a Fed rate decision and Chairman Powell news conference after that. The Bank of England and the ECB with their own rate decisions on Thursday. And finally, you'll hear from Fed Governor Chris Waller speaking on Friday to round out the week. From New York City, this was the countdown to the open. Thank you for choosing Bloomberg TV.
what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concern for many reasons. But also, we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be to protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new variant. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that, as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
How will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The island storm came in south of El Yunque, swept up towards them, down to Arizona.
Target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored.